Bueno, verde.
Ah, vale, vale, vale.
Vale,
Ah,
y
vale,
luego
vale.
lo pagamos. Vale, si se puede
Sí,
cerrar
sí.
para la batería o que sea esto
Vale.
que funcione.
Vale, no, pero es que como ayer al final dijiste tú y yo
Ya.
luego ya dije, no hice nada, digo, no sé cómo
Y
es.
Hello, good morning. I think that it's time to start. Welcome, all of you, people that are here at the Banco de España, also people who are online. Thank you for joining at this fourth We Are in Macro and Finance conference. Today, I'm gonna be the chair of this session instead of Caterina Medicino because she couldn't join us. And now we are gonna start this session about the credit and financial intermediation. The first paper is gonna be presented by Diana Bonfint, and the paper is titled Bank Specialization in Lending to New Firms. So thank you very much for being here, and the floor is yours.
Thank you so much, Maria. So this paper, it's trying to work with Ralph De Haas, Stephen Ongina, and with Alexandra Mationino, who is actually going to join Banco de España in just a few weeks, but couldn't be here today yet. And it's a paper where we talk about bank specialization in lending to new firms, and yeah, of course, the usual disclaimers apply. So specialization in lending to new firms, actually, initially we were talking about startups, and we decided to actually change the initial title of the paper because every time we mentioned to someone we were working on how banks specialize in lending to startups, everyone asked us, oh, is that an SVB paper? It's not, okay? So SVB was a very extremely specialized bank. Its entire business model was about lending to startups. All the funding model of the bank was reliant on getting funding deposits from entrepreneurs and firms in Silicon Valley. This is not what we're going to be doing, okay? So what we're going to be doing in this paper is looking into the relative specialization of banks in Portugal, and to figure out how specialized they are in lending to new firms. And so new firms are any small firm being created recently. And what we want to figure out is what is really the role of this specialization. And so let me just start by saying that actually having banks lending to startups, it's quite common, okay? So even in the US, evidence from the Kaufman firm survey tells you that startup firms rely heavily on external debt, including bank credit. And of course, in Europe, being a more bank-based system, this is even a stronger fact. So for instance, half of the Italian startup firms have a bank loan already when they are 1 year old. And there's also similar numbers for the Portuguese economy. And colleagues of mine, Josephine and co-authors, have shown that if firms are able to secure bank credit early in their lifetime, this helps them increase the chances of survival. So in the paper, what we want to understand is, well, first, if banks are different across each other in terms of how specialized they are in lending to startups, but more important than that, we want to understand how important this specialization is, if it exists indeed, okay? And so what we will be exploring is a reform that happened in Portugal roughly 20 years ago, a bit less than that had a massive impact on business creation, okay? So it was a reform about dramatically decreasing the red tape it takes to create a business. So that meant that suddenly you had this inflow of new firms being created, and many of these firms knocking at the door of the bank to get a loan. And so what we will try to understand is, when you're faced with this inflow of new firms, does it matter that you have acquired previous knowledge in lending to these very opaque firms that have just been created? So what we're going to be anchoring our analysis on is to exploit this staggered deregulation that occurred in Portugal. Okay, so the reform was called Empresa na Hora. And the idea was that, I mean, Portugal was terrible in terms of how easy it was to open a business, okay? And the reform made it incredibly smooth and easy to do so. And so the way this was implemented was the government opened branches of these offices where if you want to start a business, you can go there. And in just a few hours, you could easily go and open a business, okay? And so this implementation was, of course, staggered, okay? There weren't resources to go and open this, make this work all over the country. And so it was going in different municipalities over different years. And that's what we're going to be exploring for identification. And so, of course, you can imagine if you really decrease the barriers to entry, if it becomes so easy to now open a new firm, what you're going to have is that the average quality of the firms being created is going to decrease. And this has been shown in previous literature. For instance, this paper by Brattenstatter and co-authors and Sonny Felix and Chiara Maggi have shown clearly that, as you would expect, the quality is much, much worse. So this, of course, even makes more important to think about the role of the banks, because now you have all these firms, which are, I mean, many of them are inevitably going to fail, more even so if the quality, the average quality has decreased so much. And so what we're going to investigate is how does this matter? The fact that you have these specialized banks operating in the municipalities and the fact that you borrow or not from these banks, how much does this condition the creation of startups to start with? And then more importantly, how does it condition the survival of startups? And so in terms of contribution, I think, first, we I think are, as far as we know, the first to look into specialization in lending to startups, okay? So there's a lot of literature in terms of specialization across geographies, mostly also across industries. And here we're trying to understand what is the role of specialization in startups. And in a way it flows also, Camille yesterday also showed us this paper, so there's different angles to think about the specialization and the knowledge that banks acquire through this. And so our first result is that we show that when you have a stronger presence of these specialized bank branches, this is going to be linked to higher rates of business creation. And more importantly, we show that if the startups get their first loan from one of these banks that is relatively more specialized, this is going to significantly increase their chances of survival in the long term. So in a way, what this means is that the screening and the monitoring role of banks seems to play an important role in somehow mitigating any kind of agency frictions, agency problems you might have when you have this sudden regulation and all these new firms entering the market. Well, let me give you now a few details about how the reform worked and how it was implemented. So what we have here in this chart, the dark blue line, represents the number of days it takes to start a business in Portugal. And the dashed line is the same number for the average of the OECD countries. And you can see that around the implementation of the reform, Portugal went from taking 80 days on average to start a business to something below 10 days. Okay, so we went from being the 110th worst country in the world to being the 5th best country in the world when it comes to how easy it is to open a business. So this was really a quite drastic reduction. And of course, entrepreneurs reacted to this. So what you see is that this is just descriptive statistics. What you see is that if we anchor things around the moment one of these offices opened in the municipality, you get a strong and persistent increase in the number of new firms being created, okay? And the way these offices were open is, of course, relevant for us. So what I have here in this chart is the dark blue represent the municipalities where the branches of these Empresa Navarra offices were opening in each year, okay? And so we have 2005 when it started, 6, 7, and then 8. We stopped in 2008 because at the end of that year, it became possible to actually do this online. So then we miss out on the geographical identification. But this is just, of course, it wasn't absolutely random. The government wasn't tossing a coin to decide where they're going to open the branches. But it was as close to that as possible because what was being done was the government was trying to figure out where there are currently branches that could operate for this Empresa na Hora and also the human resources. So this happened gradually and all over the country. Okay, so in terms of data, our starting point is, of course, to have the exact opening dates of these Empresa na Hora offices, okay? So between 2005 and 2008, they opened in 84 municipalities. And then we want, of course, to compare these to control municipalities where these branches didn't open during that period of time. And so we'll have 100 control municipalities, okay? So we take away the two largest cities, Lisbon and Porto, we take away the islands, and we also take away the smallest municipalities where we have less than 10,000 inhabitants, so that these control municipalities are as similar as possible to the treated ones. Then we have data on the origination dates of every single firm, okay, and their industry classification. We have, of course, data on the municipality, but I guess the most interesting part is that then we match these with the credit register, where we have loan data at the bank firm level starting in 1999. And to some extent, I mean, the Portuguese register is kind of uniquely, I mean, the Spanish one would also do, but we cover all the loans. So the reporting threshold is 50 euros. It was like this since the 70s when it was created. So this is important if we want to study the funding of these new small firms that are being created. And of course, we don't want to look into the 50 euro loans, but we want to make sure that we capture all their financing. And then we match these on accounting data on all the firms. And here again, Portugal is quite unique because we have these financial statements covering literally every single firm in the country from their inception, okay? So we really can track these firms since they are created over their lifetime. Okay, so the first numbers I want to show you are just about making sure that we can reproduce the findings of the pre-existing papers that looked into this reform, okay? And so what we're going to be estimating here is just the dependent variable is the number of new firms that you have been created in a municipality scaled by 100,000 inhabitants. And what I'm reporting here in the table is this beta coefficient that captures how many new firms are created after the Empresa Navarra branch opens in that municipality. And so the first column is the two-way fixed effects as had been used in those two papers. But of course, since then, the literature on staggered different decision differences has evolved. So we also show the Callaway and Santana and the changes at all approach. And I mean, the numbers are very, very consistent. So what we have is that after these branches of the government open, you have on average 24, 25 new firms being created per 100,000 inhabitants. And this is the graphical representation of that. So you see that, I mean, there's nothing specifically different in the years leading up to this when we compare treated and untreated municipalities. And then you see that the effect kicks in and it actually increases over time. Okay, let's now focus then on the banking part and on the role of bank specialization. So one thing that we discuss a lot is what is exactly a startup firm. Okay, so what I'm going to show you is results for firms that are up to 4 years old, but we're going to also see some results with other definitions of startups. And then our anchor to think about how specialized the bank is this relative specialization measure defined at the branch municipality time level, okay? And so here, when I say bank branch, I'm not referring literally to a legal bank branch. I'm going to refer to all the branches of the same bank within a municipality, okay? Because that's the most granular level of data that we can have geographically. And so this measure is going to have this first component where we're going to have the number of startup borrowers that this branch has in its portfolio as a proportion of the total number of borrowers that the bank branch is lending to. And of course, we need to somehow take into account the population of startups existing in that municipality. So what we're going to do is we're going to subtract the number of startup borrowers in that municipality divided by the number of borrowers in that municipality, okay? And so that kind of takes away this average local exposure to startups and allows us to understand within this municipality which are the branches that are more or less specialized. And so then, I mean, from this continuous relative specialization measure, we're going to define a binary variable telling us this is a specialized branch, yes or no. That basically is a yes if the specialization measure is at the top quartile of the countrywide distribution. Let me just say that, I mean, we're not being original here in this measure. We're basically adapting a measure by Anne de Courroy and Daniel Paravicini that they have in a recent paper on French specialization in lending across across industries and geographies, we're adopting the same approach. And this is the empirical distribution of this relative specialization. What we're doing is we're cutting it at the top quartile in 2004. Okay, so in the year before the reform was implemented. Okay, so this is a measure that we're going to have for each bank branch, okay, in each municipality. But the first set of results I want to show you, the first part of the paper, is going to be at the municipality level. So we went first to understand if the presence of these specialized branches at the municipality level is somehow going to be important for more firms to be created, to somehow boost the impact of the reform. And so then to go from this branch level to a municipality level, then we can aggregate the specialization measure in different ways. And here we decided to show you 3 different ways of doing so. Okay, so the first one is simply to count the number of startup specialized branches in a municipality. The second one is to have the share of startup specialized branches among all the branches that operate in the municipality. And the third one is similar to that, but taking into account loan amounts. So it's the market share of these startup specialized branches. And this is just a visual representation of the 3 measures. They are for sure quite correlated, so maybe we just need one of them, but they're not perfectly correlated. They might be capturing different things. So for now, you're going to see the results with the 3 of them, but actually the results are very consistent regardless of the measure that we use. Okay, so the first set of results is to try to figure out, as I mentioned already, if you have a treated municipality, an empresa na hora municipality, and does it matter that you have more or less specialized bank branches on lending to startups? Branches that somehow acquired knowledge about how to lend to this very opaque firm that has just been creating and is now knocking at your door asking for funding, maybe without having financial statements to actually show you and show how viable the firm has been recently. And so what we're going to be focusing our attention on is on this beta 2 coefficient that captures this interaction, okay? The dependent variable is, again, the number of new firms being created scaled by the number of inhabitants. And we're going to be controlling for time and municipality fixed effects. So I would ask you to first focus on the first 3 columns, or actually to focus on the first column of this table, where we have the simplest measure, the one where we have the number of specialized bank branches. So when we look into this, what we see is that if you have one additional specialized branch in a given municipality, after the reform is implemented, you're going to have 8 additional new firms being created per 100,000 inhabitants, okay? If you look at the line where we have the standard deviation and look into the first 3 columns, you see that indeed the effects are not so different when we look at different ways of measuring the specialization of bank branches. And so we find that one additional standard deviation on the specialization measure is going to be linked to 12 to 16 new firms being created, okay? And so this is still not linking firms to banks. This is just to say there's knowledge about how to lend to these startups in that municipality. This has a positive effect. Then on the second group of columns 4, 5, and 6, what we do is we bring additional controls that might somehow also affect this. So we control for the Herfindahl index of bank lending in that municipality to somehow control for concentration of banks. And we also control for the number of active startups in the municipality over the population to control for somehow the business dynamism there. And none of these effects is statistically significant. And more important than that, it does not affect our main coefficients. Actually, things become, in some cases, a bit stronger. Okay, so let's then focus on how do these firms have access to credit, okay? And so now we're going to be playing at a slightly more granular level, okay? So now our dependent variable is going to be at the firm level and not at the municipality level anymore. And so what we will try to figure out is for a given firm, how does the firm have access to credit? So we're going to look into the extensive margin, looking into a binary variable that takes a value 1 if the firm has a loan above 5,000 euros. So again, we don't care about 50 euro loans, but a meaningful loan. And we also are going to look into the intensive margin, looking into the leverage of the firm. And again, our attention is going to be focused on the beta 2 coefficient. So what is the role of the specialized bank branches after the reform? And here we're going to bring in a few firm level controls, not a lot, because I mean, these are young firms just created, so there's not a lot of accounting information that in most cases the bank would be able to see, but still will control for size and age of the firms. And then we bring in time fixed effects, municipality, and one-digit industry fixed effects. And our sample are going to be firms created since 2004, and we're going to look at them between 2004 and 2008. And again, focusing on the first set of columns, okay, we play again the 3 specialization measures. And you see that the presence of these specialized branches in the municipality is going to be linked with a higher likelihood that these new firms have access to credit, okay? On the second one, we bring in firm size. It's a shorter period. The results are very consistent. The same goes for the intensive margin, okay? So if there are more specialized bank branches that have this knowledge about how to lend to startups, you see that the new firms being created have more access to credit after the reform. So I promised I would show you some things with different definitions of startups. And so here what we have is looking into not only firms that are up to 4 years old, which is what I showed you in the tables, and so that corresponds to the blue line in these charts, but I'm also showing you results for firms that are up to 3 and up to 2 years old, okay? And what happens here and what happens in every other place where we do these with different definitions is that actually the results are much stronger for the youngest firms. So what we're showing you in the tables is kind of the conservative estimate. If we choose to go to really newly created firms on which information asymmetries are at their highest, you see that the role of the specialized branches is way more important, okay? And so the final set of results I want to show you is about firm survival, okay? And so now here we go at the most granular level, and here what we're going to try to understand is if the startup firm has this first loan from a specialized bank branched after a firm created after the reform, compared to a firm also created after the reform that gets its first loan from a non-specialized bank branch, does this somehow affect the survival of the firm and its long-term performance overall? So again, our attention is going to be on this beta 2 coefficient, okay? And this is now going to be a cross-sectional model where we're going to figure out if the firm is alive or not after 5 years or after 10 years, okay? And we're going to be controlling for cohort fixed effects, so tracking firms that are created in the same year. And on top of that, we have municipality industry fixed effects. Let me just give you a number that it's relevant for us to think about the findings that come next. So the average startup survival rate for the firms in the sample that do have access to credit, which is what we're looking into here, the survival rate is 65% after 5 years, 45% after 10 years, okay? So conditional on getting a loan. So this is, of course, a much higher survival rate than the average startup. And so in the first 4 columns, we have the results for survival in a 5-year horizon, and then for the 10-year horizon, and we play with different sets of fixed effects. The takeaway is that if you look at the interaction coefficient, the beta 2, you see that there's a consistently significant effect, okay? So what this means is that if the firm is able to get its first loan, its first bank relationship from a bank that has past experience in lending to similar young firms, this firm has a significantly higher probability of surviving after 5 and after 10 years. And again, these are the results for different definitions of startups, okay? And once again, in this case, it's even for the 1-year-old firms that the results are considerably stronger, okay? So it's really when the banks don't know almost anything about these firms, but they still decide to lend to them, the specialized banks somehow are much better equipped to allow this firm to survive for a longer period. Here we control for other characteristics on the branch size and also one thing important is, of course, we also control for industry specialization, given that most of the literature is about banks being specialized on different industries, okay? So we're bringing that in. It also plays some role, but the bottom line is that it doesn't affect our core estimates, and actually the effect of coming from specialization on lending to startups seems to really be more meaningful than the one coming from industry specialization for these young firms, okay? So basically, this is just a graphical representation to show you that these imprisoned water firms, the one in blue, they're less likely to survive. Okay, these attest to their lower quality on average. Okay, but if they are able to secure their first loan from this specialized branch, then they significantly increase their chances of surviving. Okay, then we also look into other outcomes after 5 and 10 years. We look at firm performance, and we see that there's a positive effect on profitability, for instance, after 5 years, but it seems to be temporary, so it's no longer there after 10 years. We look into employment, so I really wish that we could say big things about real effects and job creation. I don't think they're strong enough to highlight them in a way that, I mean, they're there, but they're not as exciting as perhaps we would wish they would be, but something happens. And so let me just try to conclude on time to say that, I mean, in a nutshell, what we do in the paper is to document that, yes, I mean, there's heterogeneity when it comes to bank specialization on lending to startups. And this is important, especially, I mean, when the banks are faced with this inflow of new firms being created, on which there's a lot of uncertainty about their quality and their viability, these startup specialized bank branches somehow facilitate their access to credit, and more importantly, they significantly increase the probability of these firms being alive 5 and 10 years after that. And so in terms of policy implications, I think I mean, there's evidence that once you have a significant deregulation, you might have a suboptimal allocation of resources in the economy. That's not what we show here, but what we show is that somehow this suboptimal allocation can be improved by the screening and monitoring role that these specialized banks might have, and somehow this knowledge might counteract the negative side effects of deregulation, okay? And so here, I mean, I think we end with an open question, which is, this is a reform implemented 20 years ago when we had a much larger branch density than what we have today. So I think a question that we might have is, now that we have branches closing all over the world, if somehow this local knowledge still exists or not. Okay, so thank you so much.
Thank you very much, Diana. Perfect timing. And now Andrea C. is gonna discuss.
We're not. I mean, we're not excluding that. So, I mean, we're actually not saying anything about the match, how the match goes between the firm and the bank. Okay, we do have results on that that I didn't bring here today. Where, of course, I mean, endogeneity is a stronger concern. But when I try to figure out how do firms match and if they're more likely to select a specialized branch or not, we do not find anything consistent to report, okay? So indeed, I mean, here we were agnostic about how, I mean, and this is something where, of course, we want to work more. And clearly the challenge for the paper, I think, is, I mean, to learn if this is about the screening. And so if this is about the ability of the banks to say, you're a good firm, you're not a good firm. If it comes from monitoring and mentoring and nurturing, right? If it's because once they match, the bank is better able to help the firm grow. So I think this is right now an open question. I'm not sure we will be able to entirely kind of do it, but sorry, Abby?
If you find some narrative banks, like I don't know if I go with these banks and it's not narrative, like maybe she will
We can. I mean, it's difficult because it was 20 years ago, and so it will be hard to find many. But I mean, we definitely can. We definitely can.
The usual discussion here. Also, do you know whether new branches are created?
Of banks?
Yes, after the reporting, also new branch were also created. But I think that the genetic part is one of the most relevant ones.
Sure.
Because when we talk about specialization, we think about specialization sectoral or the firm. We need to understand what these firms are. And do you know whether there are other investors? When you think about, startup, think about launching cancer. But when you have a VC, it's very easy to get a bank afterwards.
So I'm trying to understand whether whether there have been other investors in, and that's why they get bank afterwards.
So I mean, first on the branch creation. Okay, so what we're doing is we're freezing the bank specialization in 2004, then of course, I mean, we have also looked into how this is changing after the reform and if it actually changes or not, and it does not, okay? And so this is a period where banks were still not closing down branches as much as they would be in the following decade, but I mean, they were not increasing branches at all. It was clearly had plateaued already some time earlier, and we showed that, and I mean, I actually don't think it's in the paper right now, but the specialization doesn't really, because it could also be the case, right? The effects go through time, and it could be with the inflow. The banks are still learning, but we don't see changes in relative specialization that really pop up.
The story is you have a startup I gave it to somebody else.
No, I'm so sorry, but let's suppose the story is, those startups get funding from a VC. The VC helps getting banked, which is the usual story, okay? And then the VC is nurturing and helping. So it's not the bank, but it's the VC. But the VC is attached to this bank. So you never know whether this kind of story. So I think it's relevant to understand better with the market.
I think it's, I mean, so for sure, if you think, I mean, more of the Silicon Valley type of startup and an ecosystem where you have proper financing for startups, and this is not the case here, okay? So most of the firms that are being, and actually, I mean, first we're excluding the two largest cities where most of these more entrepreneurial and financial ecosystem would be, okay? So we're looking into all the rest of the country, which is assumedly different in a way. And so most of these new businesses are very traditional businesses. These are not I mean, it's not that there might be a biotech firm there which is linked to venture capital, but that would be one observation out of the many thousands we have, okay? So these are very small family-owned businesses with an entrepreneur starting up a new store, starting up a consulting company, sometimes a construction company, okay? So this is not a venture capital kind of thing. Of course, we cannot exclude one or two firms are not there, but it's not that type of firms.
So for technical problems, yeah, can start her discussion.
Okay, yeah, sorry for the technical delays. So I'm happy to discuss this paper by Diana. So let me start by giving an overview of the literature thus far and the contribution of this paper. So this is part of a growing literature that looks at banks, which tend to concentrate their loan portfolios in particular market segments or products. So for example, industries, geographical regions, export markets, and even the type of collateral that banks accept. And then this growing literature has shown that bank lending specialization has implications for the design of loan contracts and the use of loan covenants, transmission of credit supply shocks, and also for firm performance. And then this paper provides a novel dimension with which banks specialize their loan portfolios in particular specialization in lending to startups. And they show that this has important implications for startup entry and performance. And they show this against the backdrop of a deregulation reform that was implemented in Portugal, which in principle spurred firm entry. But then as Diana noted in her presentation, this has like potential negative consequences in that you might think that lowering barriers to entry may imply the deterioration of like the quality of the marginal entrant into entrepreneurship. And they showed this nice complementarity between this reform and startup lending specialization in that in locations with more startup specialized presence of banks, there's improved credit access to new firms, higher entry and survival, and better exposed performance. So it has this very nice policy implication that banks' lending expertise in their lending to startups can help mitigate potential negative consequences of this reform. So I think this is a very nice paper. It's very clear and it's very well written. It's well motivated and it positions itself quite well with the rest of the literature. And it also provides a very novel perspective, like on these synergies between the reform and lending specialization. And we conventionally think of like banks' local presence in, say, a municipality is nice because of improved credit access, and they kind of add a nuanced perspective to this by clearly highlighting banks' startup lending specialization. So my plan for discussion will be as follows. So it kind of relates to some of the questions that already arose earlier. So first would be trying to characterize lending specialization to new firms. A related point would be trying to understand better what is the lending advantage of banks on new firms. And then the third point would be to think about more on the screening expertise of specialized bank branches. I have some smaller comments and clarifications that we can just discuss later during the break. So the first one is about thinking about what explains lending specialization to new firms. So is this like an artifact of industry specialization within the municipality, or is it a distinct channel by itself? So for example, in section 5.6 of the paper, they analyze these margins jointly, which suggests that these are two different margins, otherwise one drops out of the regression. But I think it might be good to preempt this sort of question from arising in the future. So for example, in Paravicini et al.'s paper, they show that basically they try to correlate their specialization measure with some measures that capture geographical advantage, say the bank's country of ownership and other things. And they show that while their specialization measure correlates with bank's country of ownership, the lending advantage cannot be summarized as home country advantage. Maybe you can make a similar argument in your paper as well. So in relation to this, it would be nice to check, for example, the correlation of local industry specialization with startup lending specialization, or maybe also compare the industry composition of banks' lending portfolio to the industry composition of startups that borrow from specialized banks to think about whether there's some sort of borrower-lender matching based on the industry. And then another related point that might work in your favor is to think about whether this startup lending specialization is a persistent phenomenon, because I was thinking that if it is, it might speak to their lending strategy and expertise in this market segment. Because there's other papers that have shown, for example, that industry lending specialization is a persistent phenomenon. So yeah, a simple check on this would be to just check the autocorrelation of this measure over time. The second point which is a related point, is thinking more about what is the information advantage of banks on startups, because it seems like among incumbent firms, this is easier to think about because an ongoing lending relationship serves as a channel from which banks can gather information about these firms. So for example, using transaction accounts from repeated transactions between the lender and borrower. Or maybe as a lending relationship progresses, like it seems like banks care about CEO specific information. So I wonder if we can also infer something about what specialized banks look at when they screen potential entrants or those that borrow after they start operating. So for potential entrants, do owner characteristics matter? And then for firms that borrow, like say a year after they start operating, does the startup characteristics matter somehow? So some suggestions along these lines would be to look at startup characteristics prior to obtaining the first loan, if the loan is obtained after the first year of operation or within the same year. And maybe this one is a bit more difficult to do just because of the work that has to be done. Also to look at owner or top earner characteristics, use, say age, education, occupation, using the Portuguese match employer-employee panel. Or if not these, maybe just a simple discussion, thinking about what you think might be at work here. And then the last point is thinking more about the screening expertise of specialized bank branches. This paper so far has provided nice evidence on the implications on firm entry and survival, credit access, and ex-post performance. But I was wondering about what about other loan contract terms? Because I would imagine that these startups might potentially be getting more favorable loan terms due to these banks' lending expertise. So for example, in Blickel et al., they showed that bank specialization leads to lower loan spreads for firms. So the closest thing that this paper does is to look at the intensive margin, which is financial leverage. But financial leverage can also be capturing riskiness. So I was thinking it might be good to check loan volume and loan spreads as well. And then since we're talking about the information advantage of these specialized banks, I was wondering about the role of collateral or guarantees in resolving information asymmetries. So along these lines, are startups that borrow from specialized banks more or less likely to pledge hard collateral or personal guarantees relative to startups that borrow from non-specialized banks? Because if these banks are, they have superior screening expertise and they lend to better quality borrowers, at the very least, they might be less likely to be required to pledge a personal guarantee, is what I think. So to conclude, I think this is an important and insightful paper. It has great potential. The paper has clearly shown that this specialization margin exists and it has relevant implications. I think it could also be interesting to understand better the rationale behind this phenomenon. So I learned a lot from reading the paper and I look forward to the next version. Thanks a lot.
Thank you very much. So you have like 4 or 5 minutes just to reply, and also if we can collect 1 or 2 questions more. Thank you. Let's collect a couple of questions. So we have 4 minutes.
So I had a very quick question. This is super interesting work, and this fact that banks would specialize in relatively risky firms is very novel and very interesting, and it's important to know it in a bank-based system. I wondered if back in the day, about 20 years back, there was government support of these banks, if there are maybe loan guarantees, because it looks like a very ripe market for government support in sort of cherry picking the successful firms.
I'll try this one. Does it work? I actually wonder whether you had the applications of this for these loans. I know that your credit registries are very rich, so maybe that would be really interesting. And I agree that it would be interesting to know more about the people opening this business. They maybe had already relationships with the banks, right? So the bank already knew them better. And I wanted to say that Niklas, Almberg, and Bubeck have a paper about closing branches, which actually it's very, very complemented to this one. It's like the following story. And yeah, I think it's very interesting. very much.
Hi, thank you. Super interesting. I just have because I got a bit lost, but this implementation of this policy you were looking was around 2008. So you were looking at 2004, 2008, what happened later. So I was wondering whether you checked also what happened with the Great Recession. So what was going on, whether, and also like a bit tied to what Andrea was saying, whether there was some industrialization and maybe like part of this is driving this. And tied to this, just out of curiosity, because like I also work with these things and I know it's a mess, how do you measure the exit, the survival probability? So how do you follow firms? How do you know whether these firms are exiting or not? Thank you.
I will repeat what has been said. Great paper, super interesting. And to go back to the question before, I was wondering whether not only the Great Recession, but post-crisis regulations and constraints at the banks actually killed that kind of specialization. Whether you can actually trace how these banks are doing afterwards.
Diana, I think that you can. So I think that I don't want to use a lot of. Sorry.
No, thank you so much. It's great to. I mean, it's an early draft, so it's really great to have all these questions and feedback. So Andrea, let me start by really thanking you. You were super constructive. There's many things that will go to the top of our to-do list. So I think that indeed, I mean, your suggestions about understanding the specialization, they're very good. In terms of the lending advantage of banks, I think it's. I mean, again, we wish we could talk to the bankers, and then let's try to do that. But I mean, I think it's mostly about the ability that these loan officers, bankers have to sit down with an entrepreneur that doesn't have financial statements to show to you, but you have to understand how viable, how promising the business can be. And yeah, using the quad as well, it's something on our agenda, also to look into even serial entrepreneurs and all that. So we will at some point do it, hopefully soon. And on the screening expertise, I mean, yes, I mean, we don't have good loan level information on interest rates for this period, but we can somehow have this implicit interest rates from the P&L. We can do that, and the collateral. Yes, it's something that I mean, on this challenge we face about screening versus monitoring. What is the role? I mean, this is, I think, the main thing we can test in a way. So that is something we still didn't do, but I think it's top priority to do. Camelia, on the government support. I mean, there's a big government support program for Portugal in small firms, but actually they have to be older than 4 years old. Okay. I mean, I think we can more systematically check that definitely there wasn't anything there, but there wasn't kind of a big visible program. Christina, on the applications, we do not have them for this period. And to be honest, the application data that we have after that is not super amazing, but for this period, it doesn't exist. And yeah, the paper by Bo and Nicholas, it's precisely what inspired us for the last question. On the and also in terms of the global financial crisis post-regulation. So, I mean, the global financial crisis didn't hit the Portuguese banks very heavily. Well, what was really heavy was 2011 forward. And so, I mean, there's really not a lot that we can do there. But I mean, I think what we can sees, I mean, the banks that were more severely affected in 2011. That is something that we can try to explore, and given that we have the 10-year horizon, to figure out if there's an additional level of heterogeneity there, and go deeper on that. And in terms of, you asked about measuring exit, so I mean, we're not looking, I mean, bankruptcies and liquidations reported are relatively rare, so we have that, but the most important definition of exit is figuring out that the firm is not reporting this accounting data, which is mandatory for tax purposes for at least 2 years. Okay, so that's how it. So thank you so much. Lots to do. Thank you.
Thank you very much. So. Great. Thank you very much. Let's continue with this session. So now, Baso Yanidou is going to present the paper entitled Corporate Runs and Credit Reallocation. So thank you very much for being here.
So this is a paper on corporate runs. This is joint work with Elena Carletti, Filippo De Marco, who are at Bocconi, and Enrico Sette, who is at the Bank of Italy. So the usual disclaimer applies for central banks. So let me tell you a little bit about this project and what it's about. So we know, maybe, shall I use it or no? I stay, it's fine. So this is a paper, I mean, we often see bank failures, and more recently we see them more often. And we know from existing literature, they have big economic negative effects, declines in credit and economic activity. Part of the often fragility related to banks relates to runs. We've seen them a couple of years ago, and they have come back to our attention. From the existing literature, we know quite a lot about how depositors behave in periods of runs. Okay, so existing analysis with microdata, very detailed, can tell us a lot about which depositors run, when, and so on. How do they behave during periods of, bank distress? Now, what we know much less, and this is what this paper is about, is the asset side dynamics. Okay. Now, let me refresh a little bit. I mean, if we think about the events in the US in 2023 with the SVB failure, one of the novel aspects of this particular run, it was that we've seen very large and very rapid deposit withdrawals from corporations. So corporates were on the center of this fragility. Now, when one thinks about corporates, we think there are two key, which are central to our analysis. There are two key differences about corporates versus other clients of the banks. On the one hand, when it comes to having deposits at the bank, the corporates typically have bigger amounts. They have substantial amounts which are uninsured, and they are as a total of their total deposit funding of the bank, they are a significant part of the total deposit. So in the EU, it's about 25%. In the US, it's even more, okay? And most of these amounts are uninsured. So that's one key difference compared to, if you want, in the EU, 96% of EU households are fully insured, okay? They have become less, yeah. Right. So now another important difference, if you want to hear, is corporates are also borrowers typically on the asset side, right? So they rely on the bank for obtaining credit for their operations. And so it's possible that if we see the firms leaving the bank, they're also not leaving simply their deposits from the bank, but also they are taking away their loan business away from the bank. And so, for instance, why would they do that? They may be looking to establish new relationships to guarantee if they have concerns whether their main bank is going to be a viable bank, they may look to establish a new relationship with other banks. That's the triational paper, if you want to. Especially good firms with good investment opportunities, they may try to go elsewhere. And so that is going to generate a process of an endogenous deterioration on the asset side of the paper. And this is what this paper is about. So we are going to be documenting this endogenous process of deterioration, and we are going to start by analyzing a bank run and going back in time. Typically, most studies start at when the failure period, but we will analyze how they get there and try to understand from that. And that we think this is important if you think going forward, because with online banking and social media, the speed and the magnitude of runs and the intensity of runs is only expected to increase. So this is what this paper is about. So the key part here will be to study the earlier period and also the asset side dynamics and their interaction to the liability side. So what we are going to study is the failure of 2 regional banks in Italy. It's 6 banks in total. In 2017, they failed. We will call the distress banks. So throughout, I'm going to call them the distress, and everybody else is not distress. And what we are going to do is shed light on the corporate clients' behavior on both sides of the balance sheet. All right? So we are going to track their deposit flows and their loan applications to other banks. And also we are going to study what the implications are on the loan portfolios of these banks and what spillover effects they have on other banks in the region. So this is what the paper is about. Right. So I'm going to give you 4 sets of results. So the first are going to be informing you about these deposit runs, what is happening. 2 key insights from this. We are going to see in a minute in some graphs and tables that deposit runs begin as soon as the bank's problems become public. And the behavior of firms and households is quite different. All right. So the timing, so firms start first with greater intensity, and their choice of new banks is going to be different. We are going to also see a simultaneous deterioration on the asset side. Basically, the high risk or low quality firms are going to be drawing down more from the distressed banks on their existing relationships, because there is an existing literature that sort of says that when you're concerned about your bank, you want to try to, whatever has been committed, you draw it because you may be afraid that the banks can renegade those commitments. And these are corporates who are not going to be able to move elsewhere. Instead, their best customers are going to start applying and getting relationships and transitioning to other banks. So this is going to be the key result, which is going to lead to pretty substantial deterioration early on before the large run begins. Okay. And then we'll study some of the firm outcomes and spillover effects on other banks. And what we are going to document is that there is a cleansing effect on other banks. And I'll give you some more information on that, but I don't give you everything already, so you can still stick around for a little bit more. All right, so the experiment. So this is the failure of 2 large mutual savings groups in Italy. It's about 40 billion in assets. These banks were mainly operating in some of the richest regions of the country. So the economic activity there was strong. So it was not that there were major problems. In fact, the economy was growing. These banks got in trouble for idiosyncratic reasons due to accounting frauds. And basically, there was an article that leaked these things and their problems in the press. And then everything became public, and that's when the run starts. In terms of size, on a national scale, these banks are not huge, right? So they are not systemic at the national scale, but they are regionally important, so they could potentially have regional effects. So they were about 10, 11 in the country, and about 25% of the firms in the region had a lending relationship with these institutions. Right. So timeline of distress, just to give you a bit. So we are going to describe, normally in a paper you have post, okay, pre and post period. So here we are going to have pre, post 1 and post 2. We are going to break the post period into two quite distinct segments. The first segment was when the news first broke that the banks had trouble. So that's a leak in the press from ex-employees of the bank who spilled the beans. So the 24 Ore in Italy published information about this, and then about loans for share practices, and there was a lot of negative press that started, and runs began. And then there's going to be a second period, which basically there is the ECB SREP report came out, and they said, well, these are more widespread than we thought. The banks are undercapitalized, and there will be a second round, and we'll kind of finish the bank, basically. All right? So I'm going to give you some more information. There will be attempts. So the regulators and the Italian state was trying to save the banks, but we will argue there was a little late eventually, and that has allowed this endogenous deterioration to take place, and it was not possible anymore to save them. All right, so just to give you an idea, so here we have Google Trends, and you can see here a spike. So this first spike is when so this is a quiet period, and then the first news arose that the banks were in trouble, searches for the name spike, they remain elevated, then the SREP report comes out saying they have problems, another big spike. Here, Atlante Fund was when they were trying to kind of recapitalize the bank, it eventually failed, and then another bank took over, and the bank, effectively they were failed, and they were taken out by another bank with government support. So what we are going to do, typically most people are going to focus in this period. Most existing studies are looking at this moment. What we are going to do, we are going to start actually from here, the quiet period, study as the onset of distress is coming in and they are in the news, what is happening on both the liability and on the asset side, right? So this is what the paper is about. So here are the deposit outflows. So here, basically, we split the banks. This is an unconditional graph, just descriptive statistics. Whatever you see in here, you're going to see in regression analysis later, but I like pictures much better than numbers, small numbers with stars. Okay, so what you see here is the graph for the non-distressed banks. So the deposits are going up. This is scale at 1 at the beginning of the event window, which we break down into the pre-period, post-1, and post-2. And what you see right here, you are going to see that the distressed banks start to lose deposits. So there is there's a slight decoupling starting a little bit before, so there must be some leaks. And then eventually, as the publication of the article comes out, you get about 10% drop. It looks like it's stabilizing. Additional news comes through which are negative, and then you have the big run. All right? So what we are going to do here throughout, we are going to split this into 3, the pre, the post-1, and the post-2. Okay? And I'm going to give you 3 sets of results, one for deposits, credit, firm outcomes, and spillovers to other banks. So results number 1, we have them in a table, but here with the dynamic definitive, you can see much better what is happening. So here we have, you can see basically that everything is stable, and we split the outflows between households and firms. And what you can see here is that the firms begin as soon as the publication of adverse information about the bank starts. So this is the first line. So deposit outflows begin from corporates begin immediately. The households are much more sticky and stable. You can see here still at 0. And then eventually, when the SREP report comes out, that's also when households begin running, but with much less intensity than firms. So firms begin early, much earlier, almost a year earlier, and with greater intensity in both periods. So that's result number 1. You can also see it in sort of unconditional graphs. You can see it here in a graph that is not, well, let's see it later. Now, the next thing we do is, okay, they are leaving the distressed banks. Where are they going? Okay, so where do they go? Well, it's actually interesting, and that's probably a novel result, because most of the time we either know for total deposits or we know only for households. That's kind of the existing literature. But households, where do they go? They go to large banks regardless of their capital. So they seem to be sort of going to systemically important banks for saying, okay, I will park my money in a big bank. Where do household firms go? They go to better capitalized banks regardless of size. They are looking for a stronger fund. They are leaving a bank which has fundamental problems, and they are trying to find a bank that is better in that respect. And there could be various reasons why that is. Maybe they're more sophisticated. That's one idea. Another is simply they are looking for different services from these banks. Okay, so while a household may be looking for a safe place to park money, a firm is looking for a credit provider, and they will prefer a more strong bank, which will be a more reliable supplier of credit, potentially. So that could be one reason. So this is results about deposits. I'm done with deposits. Now I'm moving, what is happening to credit? So the first thing we do, in line with existing literature, we know that typically in moments where there is bank distress, there are creditor runs. What creditor runs typically are, in Ivashina Scharferstein, Ippolito, and others, is that what has been documented is if there is questions about the bank, what the firms do is that they draw down existing credit lines from the distressed banks in anticipation of future possible renegation or cutting down. So what we are showing here, we are studying the drawdowns within the same firm between the distress and non-distress. And what the results show us is that this early, so what we care, I mean, of course we care about the whole post period, but we are much more interested, that's where also the novel results are, is the early part. So post one, what we learn is that only the single relationship high risk firms are the ones drawing on credit lines. These low risk firms, whether single or multiple, are not drawing early on. Now, what I'm doing with high and low risk, a lot of the results I'm going to show you is going to be high and low risk, and I'm going to be using sort of an external credit rating, which is sort of an Altman-Z score computed by CEPR in Italy, and I'm going to be classifying the very high risk companies. Now, I'm calling this high risk, but they are not just only high risk, they are actually bad firms, okay? When you look at in terms of investment rates, in terms of profitability, in terms of TFP, these are not good firms, okay? So these are the strong firms, these are also not good from an economy perspective. Here we take a risk management perspective, but if you look at them in terms of productivity, they are not strong firms, and we provide these results in the paper. So initially, what we find is that it is the low risk single who have difficulties transitioning, drawing down the existing credit lines from the distressed banks to a greater extent. All right, now. We have data on loan applications, so the next step we do is study loan applications to what we call outside banks, according to the literature, to new banks with which they don't have an existing relationship, right? So we look at, are they applying elsewhere to establish new relationships? And so the results basically suggest, and you can see here, that as soon as distress begins, okay, low risk firms with single relationships, so that they completely depend on these distressed banks, as soon as they hear that the bank is in trouble, they begin applying elsewhere. All right. We don't see such movements for the high risk. Those are drawing on the existing relationships, and multiple, they have existing lenders to get credit from. And as I said, these low risk firms are better firms. You can see this. How do I do that?
Maybe
yeah,
it doesn't work. So
yeah, it's
maybe
okay.
it's
Then it's okay. Yeah. All right. And if we do the dynamic definitive, you see really this begins as soon as the publication of the articles begins. Loan applications to outside banks begin as soon at the beginning, at the onset of the post-1 date, as soon as the 24 Ore publishes the information. All right. So, and they remain high throughout the period. Okay. So they are trying to establish new relationships. what happens? Do they manage to establish new relationships? Yes, low-risk firms, they are able to establish new relationships with better capitalized banks and larger banks who potentially have more capacity to lend to them, okay? And provide a more reliable and stable credit supply. So they may be choosing these banks on purpose, and these banks have the capacity to accommodate these new applications. So this is basically what we are showing is they are good customers who rely completely on them. As soon as they hear bad information, they start applying elsewhere, and because they're good, they are able to establish new relationships. And what's happening to the bank is that they remain with their worst clients, okay, who even draw more of the existing credit lines. So that's a deterioration on the asset side. All right. Now, what is happening to the banks, to the firms? So then we started at the firm level. Okay, are they able to get enough credit from other banks? So what we find is on the total credit at the firm level, when you run regressions at that, you are going to find that the good firms are able to, they see a small reduction in credit, which is very temporary and is immediately compensated after a few months, while the bad firms are stuck and they see a decline in total credit. Okay. Now, as I said, this implies an endogenous deterioration on the loan portfolio of these companies, and we try to kind of measure that. So here, what we are doing here, we are any loan that if you are a customer of these banks, you could get a loan from them or you go elsewhere. So all these new loans that they get from outside banks, if you compute it, and here we do that at any point in time, any company who has a relationship with a bank can always get it from their existing or from a new one. So we here accumulate the outside loans of these two groups, right? So the distressed banks and non-distressed. Of course, this is going to be trending upwards. Why? Because every point in time, a company will always get, at some point, switch for whatever reasons, okay? And in fact, the switching rate of or getting loans from others until the onset of the publication of the article is moving in the same way. And then they start decoupling because these distressed banks clients are to a greater extent actively trying to switch and go elsewhere. And what do you see is that it opens a gap. Now, this gap begins right after the publication, and this is before even the SREP. This is where the SREP report comes, but the gap has been already formed. Nearly all of the gap between these two lines has been formed, and it's about 10% of the loan portfolio of the companies. So basically, what I'm saying here is, if you take this difference as a proxy of the lost business elsewhere, it's about 10% of the bank's loan portfolio, which already forms before the onset of post-2, before the big runs. So in the background, there is a deterioration, which is about 10% of their total loan portfolio. And if I was able to click on this, it's going to show you that this is all driven by their best customers, the low risk. Yeah, because the high risk, maybe I should be, but okay. Yeah. I will get to it at the end. Now, what is happening on other banks? Well, other banks in the region, they are all of a sudden getting applications for pretty good customers. Okay, so what are they doing? Well, they accept the good customers and they push out their bad customers. So it's an opportunity for other banks to cleanse their portfolio, especially banks that have lower capital ratios. So you can see that here we are interacting with exposure and higher risk. And the exposure measure is measuring the amount of applications they are receiving from the distressed banks customers, and they cut down credit to their own existing high-risk borrowers, especially if these banks have low capital. So it sort of tells us that there is this process has a good effect in allowing other banks to actually improve their portfolio, and eventually what we are ending up as a situation is that the good customers are able to transition. They are getting credit elsewhere. The bad customers are kind of, they receive much less credit, and other banks in the region are able to improve their portfolios. So there are positive cleansing spillover effects on other banks. So These runs are destabilizing for these distressed banks, which had serious corporate governance and fraud issues, but maybe stabilizing for the system as a whole, all right? Now, of course, if you do want to save these banks, if that's what your objective is, well, better start earlier. Start a year and a half earlier, because this process that goes on slow on the background is basically leaving the supervisors with no other option. That's kind of what I wanted to say, and maybe let me show you some of these graphs I couldn't show you earlier. So here it's actually from Banco Vitali's report, and you can see these two decoupling. So until here, the two move the same, and then there is this process of endogenous deterioration that basically leads to a couple of years where the two banks decouple. And here, what I told you about, that these high risk are bad firms, high risk is here. So these are the high risk. So the banks are left with their worst customers in terms of profitability, in terms of productivity, TFP, in terms of the investment rate. Okay? Or if you want, here we compute, so here is when we do the overall 10% loss of the portfolio, this is basically all driven by low risk customers. Okay? Now, so one thing I wanted to say is that, you know, once the bank starts losing the deposits, okay, I'm done. Yeah. So once the bank starts losing the deposits, of course, it's a funding shock. So you could imagine that they are also going to be cutting supply potentially. Now, we don't know, and it's not necessarily that it matters for the story we want to tell, because whether it's driven by the bank losing the funding and is endogenously deteriorating because it's not able to give loans, or whether the firms are actively leaving, is at the end, the deterioration takes place. However, the heterogeneity in the descriptive, in the analysis that I'm showing you, that it is the single relationship, low risk, and so on, and some other results I skipped through, which show that we don't see, while we see a decrease in credit, we don't see an increase in pricing. I skipped those results, but it suggests that it looks more like a reduction in credit demand rather than a decrease in credit supply. So given who is running, and given that we don't see jumps in interest rates at this period from the distressed banks, this looks more like an active search to find new relationships rather than being pushed out. And also, they wouldn't push necessarily out their better customers. One other result we show is that these are the ones that for which you know, the expected returns are higher. They are left with these guys. So for which, given the losses and so on, and the rates they charge, they are not, they are below zero. So their profitable is actually the ones that they lose. I'll stop here.
Thank you very much. Yeah. So I hope not having more technical problems. Perfect. Thank you very much. Now, Diane Piret is going to discuss this paper. Thank you.
All right. Thanks to the organizers for inviting me to discuss this great paper of Vaso and her co-author. I really enjoyed reading it and thinking about it. So let me jump into what the paper is about. I think it's about some idiosyncratic bank runs and the following deposit credit reallocation to other banks. So the event specifically they're looking at is a failure of two regional banks. They call them the distressed banks in Italy in 2017. This followed several flows of bad news about the bank's fundamentals. First, a scandal in the media about the accounting practices of the bank to inflate their regulatory capital ratios. And then a second disclosure, the regulatory disclosure by the ECB in its supervisory review, end of 2015. And the paper describes the reallocation of deposits and loans inside the bank, but also to other banks following these events. And they have data on corporate versus household deposits. They can also distinguish high versus low risk borrowers with single or multiple bank relationships, and look really at this spillovers, this reallocation to other banks in the region. They rely on very super nice data that everybody should be jealous of. They rely on supervisory data sets from the Bank of Italy on deposits at the bank province level, loans at the bank firm level with credit registry and also loan application data. And this merged with financial statements of banks and firms. And there's a lot of, well, I say 9, but probably it just felt less than 10 separate different regressions where they show basically how this moves dynamically throughout this period. So in a nutshell, the results is about what happens following these 2 waves of news. One is this the scandal in the media, and the other one, the regulatory disclosure. And you could think about a simplistic way of picturing the balance sheet of these distressed banks as a bank that is financed by corporate deposits, household deposits, and equity, and invest in liquid assets and loans are separated between low risk and high risk. What happens after the first scandal about the accounting practices is that they see a run from corporate depositors that is also coupled with credit line drawdowns from the high-risk borrowers. So this is the phenomenon of double bank run that was already described in the paper, for example, of Ippolito and co-authors. And it's actually also, I would say, even a triple run, because you have other corporate borrowers who leave the bank, so a negative credit demand shock for the distressed bank. After the second wave of news, so the regulatory disclosure by the ECB, confirming the bad practices and even showing more weaknesses of the distressed banks. Now you have more corporate runs, more runs from corporate depositors that are also followed to a less extent by runs from the household deposits. And what they see is that still low-risk corporate borrowers leave the bank, negative credit demand shock for this distressed bank. And on top of that, now the bank is starting cutting lending to the high-risk borrowers. So you have both a credit demand shock and a credit supply shock, but for different types of borrowers. What happens in terms of reallocation to other banks? Well, the non-distressed banks, they attract the deposits, large banks for household deposits, well-capitalized banks for the corporate deposits, and also attract the low-risk corporate loans. And at the firm level, only the high-risk firms get credit rationed, and they see also lower investment rates. So my take of the paper, on the paper, is that they're describing actually what I would qualify a good bank run. And maybe because they are idiosyncratic bank runs, they don't happen during an aggregate crisis, so they are less prone to amplification mechanism. Of course, these runs, they come because there are bad news about fundamentals, so there's solvency risk that implies liquidity problems, but the other way around is not necessarily true. They are not amplification or fire sales or the contagion mechanism and so on. And I think part of that is because these low-risk borrowers move by themselves, they go away, and so the distressed banks can pay their redemptions. Other banks are actually happy to attract the low-risk loans because they're also subject to regulation and they are competing for these low-risk loans. And they further reduce lending to high-risk borrowers. So overall risk is reduced in the banking sector. So looks like very good news. My comments will be like, there are many results in the paper. I was talking about 9 different diff, but it's not always clear to which economic mechanism we're actually providing evidence for. I will talk about several, but I mean, that's again a question for the co-authors. I will also talk about one in particular, maybe more about bank competition. The second is more about my second comment is about the message of the paper and the policy relevance of the results. What can we learn from this experiment? And then, well, I don't believe in they lived happily ever after. So I would think that there's also a bad side to maybe a good bank run, but I probably won't have time much to talk about this. So my first comment is, well, there are I'm sure I have the impression there are many economic mechanisms present in the paper. Whether we could actually talk more about that, what is the results really providing evidence for? I already talked about the fact that this is an idiosyncratic bank failure, that is where the bank run seems to be based on the strengths of the bank's fundamentals, so it's not the sunspot view of a run. But is there more to say about this particular event here? Market discipline seems to be different for different type of depositors. There are frictions in credit markets here. The role of relationships seems to be important, and I will spend more time on competition. So when I see that, first, that there are these two major players, at least in the region, leaving the market, I was thinking, is this just a waterbed effect that, well, you push the water somewhere else? Or is there some implications for loan terms in the region? You have two banks less, so it could mean less competition, but if these are two banks with a lot of market power, it could actually increase competition. And it made me think of another paper I recently discussed, where they have a similar mechanism, although it's not about a bank failure, but about the enforcement of an asset cap on a bank, on Wells Fargo, that basically forced the bank not to take any more deposits, and then they studied the deposit reallocation to other banks, other competing banks. And my suggestion would be the same for that paper. Here you have actually interesting data, since you can actually observe several loan rates from different banks to the same firm at the same time, which means that there's variation at the bank level, which could be basically a measure or an estimation of bank markups, and whether you can trace this evolution by bank and over time after the events. My second comment is about, well, I have the impression that there's a message, an important message in your paper. In this case, where this is an idiosyncratic bank run, solvency risk implied liquidity problems, but the liquidity problems don't necessarily reinforce solvency risk, in the sense that there's no really fire sales, but also there's a role of these low-risk borrowers who leave the banks, the distressed banks. And if they didn't leave the distressed banks, I would think about the counterfactual. Think about these distressed banks, what they're going to do. Then it's their choice, basically. How do you repay the depositors? And if for some reason, maybe regulation, you don't want to touch your liquid assets or your low-risk assets, you start selling high-risk assets, maybe then you start having a problem to sell those assets because the other banks don't want them. They're also constrained. So I would think that maybe even in that case where it's idiosyncratic, you could still have an amplification and contagion in this case. Anyway, I have more comments, but I can talk later about this. I find this is a very interesting paper of a good bank run, and the competition in the banking sector for these low-risk assets help the distressed banks meet depositors' redemption. Now, we can also think about whether there's a bad side of that, whether actually you are killing the startups of Diana. But that's another comment. Thanks a lot.
Thank you very much. So I think that we can collect some questions from the audience.
So very interesting. So I was wondering if you could say a little bit more about the resolution regime, and whether the Banca d'Italia played any role in kind of steering expectations that some banks would be left to fail or not to fail, and whether there was a kind of firewall, kind of an indication that they would do something in case of contagion. I mean, was there any policy response, and what was the resolution regime during that period? Because there was the implementation of a European, I don't know exactly when it happened, yes. So.
Very interesting and creative paper. I really enjoyed it. Actually, I didn't get the point that it's a good run until the discussant. In my head, it was actually a bad thing. But maybe because for me, it wasn't clear that the banks necessarily had to go under, right? I mean, I don't know whether this was like a done deal, they have to go under. And then I was thinking about the net present value of the firm. If you lose the good guys and the relationship value and the component of the net present value that is the higher, you're decreasing your net present value. So actually you might become technically insolvent from a net present value point of view because you're using your soft, if you wish, so actually didn't this push them towards, then investors don't want to finance them because they, if they see them not just today, it's a liquidity shock, fine. The bank is going to give you some loans and you're going to meet the withdrawals of the depositors. But then as an equity investor, including the government, should I bail out this bank or not? Should I put taxpayers' money? Should I, as an outside investor, put in money? I care about the net present value and the good guys living is a bad thing. So I didn't realize it was a good run until the discussion.
An absolute here. There are good and so any more? Yes, Abby?
Sorry, I have to wait for my.
Yeah, no worries, no worries.
So yeah, I mean, it is very interesting, I think. But like, there's something that I think I felt like it was missing. So usually we have a lot of theories of bank runs, right? So we have a lot of regularities in the theoretical literature about what a bank run should look like. And I would like to see in the paper something that, you have a nice narrative, give us some theoretical background. Tell us what theoretical papers would say about a bank run, and tell us, look at this narrative, how much there is there in theory and how much we have in the data, which is relevant and which is not, of the features of the theory. So that's all.
Thank you. Thank you. Let me start. Oh, yes. Victoria, yeah.
Hi, thank you. I just wanted to point something out that I don't think you mentioned or discussed, but there's a sense in which if these banks, because of this bad news, were getting closer to a bad situation, they could risk shift on their asset side and actually choose to make these riskier loans. So is there anything in the data that tells you that, it's not really what they're actually looking for, that it's bad for them? Because it does help to take risks in this situation, I guess. Thanks.
Okay, thank you all for your comments. So let me quickly say something to this comment. So in the data, I skip the parts where we study the Kwajalein analysis, but in post 2, the bank, once they are in serious distress, they do cut credit supply to zombie firms, if you want. So there is that part at that point where they are left with no option. They kind of, which is in line with results from the existing literature, including a paper by Diana and others. Potentially, these banks were engaging in, if you want, to some zombie lending before, but not to a greater extent than the control group, yeah, so than the rest of the system. Once they were against the wall, their incentives at that point to engage in this. So maybe without absence the pressure, they will have continued giving that. Now, let me go back to Diana. Thanks a lot for your very thoughtful discussion and comments. I particularly like what you said about studying what are the implications in terms of competition. That's something we haven't done, and it could be, I'm not sure I will put it in this paper, but it could be, because it's already, as you said, but I think it will be an interesting thing to study further. The way we are studying this, imagine we had SVB, right? So, and it was an idiosyncratic failure of an institution which was very peculiar, was taking excessive risk, if you want. And SVB is actually more peculiar. What we are describing here is a situation which, yes, in some sense, it was a good run, in some sense, a good run exposed, but it's an outcome that it was a good run. There was no ex ante. It could have been that it was a contagion, because it's not, we are talking about 2014, 2015, 13. So this is right after the sovereign debt crisis. Monte dei Paschi has problems. Other banks in Italy were having issues. So it could have been that it could have caused contagion. And what our results show is that, no, it didn't. And that's a result, actually. And if SVB is more peculiar, if you actually, there's a beautiful paper, Failing Banks by Stephen Black and others, and if you look at the data, which are systematic analysis of runs since the 1800, 1900 that they put together, what we are documenting and even the dynamics that we see in the graph are very similar of the representative type. It's just that there is this long period of deterioration, and what we are doing in this paper is kind of documenting the dynamics of how you get to the big run. Typically, we see the big run like the one we saw in post 2, but how do you arrive to that moment? And that's where the paper fits in, and that's all we are. Yeah, whether it could have been avoided, I think maybe, it depends on what definitely there was a value destruction for the equity holders of this company, and maybe it could have been saved. And in fact, the Italian authorities did want to save it. It was not that they said, okay, these guys misbehave, let's close it down. That was not the intention. It's just the process was too long, and basically led to all this endogenous deterioration that at that point, what was left of the bank by the time Atlante came in was not much. So if anything, if you want to do that, you really need to start early and take the measures that are needed. That's the message we want to give. And also, maybe the answer to everything is not this is maybe not my co-authors, but is mine. Is the answer to everything is not, let's insure everything, okay? So because right after this, there were proposals both in the US and in Europe, let's increase the deposit insurance by a law to corporations and so on. And not all is dark, okay? So the good firms are able to transition typically. So, in absence of big systemic crisis, it's possible to transition and without big effects, and retaining some market discipline in the system may not be a bad thing, because yes, of course, with a big bazooka and ensuring everything we can eliminate if you want runs, but there are next period moral hazard issues to think about. So that's the message that we are putting out there, or at least I am. But in terms of resolution, it was before the changes in resolution. They were trying to, these were not playing. What else? I stop here. Thank you.
Thank you. Thank you very much for the presentation, the discussion. Now we have a break, and let's resume at 10:30. So thank you very much.
now. Okay, now it's green. I see. And you turn it off. Switch it off.
The same. You press a little, I think, and wait, or press a little. Keep pressing.
So should we sit and start the session?
Yes, because I can't sit. I mean, you can choose, but I like.
Okay, so let's start this session on inflation redistribution. We have two papers. The first is by Daria Finocchiaro from Sveriges Riksbank, and it's on liquidity, capital pledgeability, and inflation redistribution. Floor is yours.
And this doesn't work.
Yes, I stand because I can't stay still. It's this one. Yeah. Yeah, right. Thank you. So this is like a joint work with Paola at Federal Reserve Bank of Cleveland, Julian. I am also a central banker, so we talk about inflation, the usual disclaimer applies. So, and what I'm going to talk today about, it's inflation and redistribution, all topic in monetary economics, but the fact that we actually experience high inflation in the recent years revamp a bit the debate. And it seems to us, okay, so if we talk about inflation redistribution, what we mean is that inflation is something that is good for the poor or for the rich. Newspapers don't seem to have a clue about it. So the Wall Street Journal thinks inflation it's something that disproportionately hurts the poor. New York Times has an opposite view. But it's not only the public debate or newspapers that don't have a clear answer to these questions, because even in the literature, it seems that it's a question that can have multiple answers. Why? Because it depends, because some people think that actually expansion in monetary policy is something that is good for cash poor people, because it gives some partial insurance. Others view instead like inflation as a progressive tax on savings, and in that sense, it's something that hurts more rich people with higher wealth. Or it could be seen, but the inflation could also be seen as a regressive tax on monetary transaction. And if it's poor people that rely more on cash, then inflation is something that's more hurtful for them. And what we do in this paper is evaluate, try to figure out what's going on. And the way to do it is like build a model that has all these elements in it, and then evaluate the welfare cost for borrowers and lenders of expected inflation. And here, during the talk, I will talk about inflation, but what we really mean is expected inflation, which is something very different from the paper you will see later, where you instead Abby will talk about inflationary shocks, if I recall right. And our contribution, so it's like have a model where you can measure all these channels and uncover a novel redistribution mechanism that is actually linked to the collateral channel of monetary policy. But in the long run, usually when we think about collateral channel, the fact that monetary policy has an impact on asset prices and through that channel has an impact to borrowing and lending is something that that has to do in the short run. While here we will talk about money neutrality in the long run. How do we do that? And now let me explain the long title of the paper. We build a model, macro-funded model of money. I should do this, because this is not very working, and it destroyed my hair, so I think it's much better. Given that we're streaming, here I am. So it's a micro-funded model of money with capital. And if you are in this literature, you know that it's very easy. It's very difficult in a theoretical model of money to get coexistence between different assets. How do we do that? Well, because these different assets that are in the model, they have different roles. So money will be a liquid asset that is used as a means of payment, while capital is a storable factor of production that has also collateral value. We have also borrowing and lending, and the way to generate that is like assume that people are different. Some care about the future more than others, and that creates credit flows between borrowers and lenders. And then we look at the effects of an increase in steady-state inflation again. That what inflation in our model does is like reduce monetary transaction, and then reduce also the demand for capital, because capital is used in those markets where where money is also used. And hence, which means that inflation will have has an impact also on capital accumulation in the long run. So it's really talk about money non-neutrality in the long run. And given that capital is also is used as a collateral, through that channel has an impact also on debt. And the crucial assumption is really that capital is productive and is used in the market where also money is used. And then, given that what we do is also, it's really like a simple model. What we do is calibrate or do some envelope, back of the envelope calculation, calibrate our model in US data, and find that actually inflation is something that it's hurtful for both borrowers and lenders. But it's mainly lenders that the welfare costs are higher for lenders. And then it's like we look also at the effects of inflation on wealth inequality, and there is not inflation doesn't have a linear effect, and it actually matters also what's the maximum LTV level in the model, and we show that we show so that for high level of LTV, inflation actually can increase wealth inequality. So let me, given that it's 25 minutes talk, let me just explain the model with pictures. And let's see if I spent much more than 25 minutes to make this picture. So let's see if it was worth it. So this is like, I don't know if you, so all these questions, they're all questions in monetary theory. What we do is really like try to merge different branches of literature that usually don't talk to each other. So it's like Lagos, right, the money search kind of theory with models with collateral constraints, with models where inflation has an impact on, there is a link between money and capital. And how do we do it? I don't know if you're familiar with the Lagos and Wright model. We have like, we assume that there is like there are like two markets, and there is like a sequential, these are like sequential market that repeats over time. We call it like DM and CM following the Lagos and Wright tradition. So it would be like decentralized and centralized market. But actually in our version of the model, we have competitive pricing in both markets. And what's the difference between these two markets? Why would we need these two markets? Because when you are in the DM, the centralized market, people are subject to trading shocks. So you don't know when you enter idiosyncratic trading shock. You don't know when you enter in this market whether you would be a buyer, which means that you will consume the good Q with utility that gives you utility small U, or with some other probability, you can be actually a seller. So you will produce this consumption good. And the crucial assumption here is actually that to produce this good, you need capital. And then if you wonder why this probability don't add to 1, it's just because with some remaining probability, you don't do anything. You just like are lazy in this market. And the crucial the reason why you need money in this model is because the crucial friction that you have in this market is anonymity. So you can't, you don't, there is no record keeping. There is an enforcement problem. So the only way to trade between buyers and sellers is actually to use money. But this money is like actually the second market is the centralized market. And there is there is where you actually decide how much money to bring to the next market, how much capital to bring to the next market, and how much borrowing and lending you bring to the next market. And all that, you see, you need to do it before you actually know whether in the next market you will be a trader, or sorry, buyer or a seller. What you do in this market is also consume a final good X with some utility. And what's the crucial assumption here is that you actually have that utility is semi-linear. Why do you do that? Well, we kill all wealth effect money demand, but I simplify a lot aggregation. So that's why usually that's an assumption. And this final good here is produced with labor. We have also a version of the model where capital is used also in this market. But for simplicity, we start with this because then we can derive lots of closed form solution results in this version. And money is just like lump sum monetary policy. It's a bit boring, but it's just like lump sum transfers. You print money and you give them to this to the agents. And the crucial friction in this, it's like again an enforcement problem. Credit can be used in this model, but all credit is collateralized, and which is like this collateral constraint. I'm not very good at using this. Well, the thing that is like where it says enforcement, that's a collateral. Yes, thank you. Thank you. Even like a Valletta here, that's the Italian speaker. Thank you. So there is an enforcement, it's a collateral constraint. So you can borrow only up to a fraction theta, it's where and theta is the maximum allowed LTV, and you need to use capital. Why do they borrow land? Because exactly, so they borrow land from one centralized market to the other centralized market, and the reason is because they have different discount factors. No, but it's boring. Let's don't worry. Because yeah, it stopped working. So let me just I'll show you, the only question I'm going to show is like some optimality condition to explain how the model works, and then we can go to the results. So basically what happened is because this assumption we made of linearity of work in the second market, the amount of consumption in the first market, in the centralized market, sorry, it's not something, it's constant, it's not something that is age dependent, and it's not impacted by monetary policy. At the same time, but monetary policy and money demand is given by the second equation. It has monetary policy is something that has an impact on the consumption of the second market. Why do people hold money in this model? Well, it's like, of course, they equate the cost of carrying money across period, which is something that depends on inflation, the cost of money over your discount factor, and then the liquidity premium. And the liquidity premium is really something that has to do with the marginal value of spending the dollar in the next period, and then the probability of being a buyer, which is like the probability that you will actually need money. What about capital, and that's something that is like, in a way, we don't do much in that respect because it's very similar to what you would get in a standard model like Lagos and Wright. But in our model, there is also capital. And you see that like for patient people, they value capital because of its return in the DM market, in the decentralized market, while the borrowers or like the less pension people, they value capital because of its return in that market, but also because it has collateral value, so that which is like the second term. Then, as I said, there is another asset which is this like IOU between people in from CM to centralized market, from centralized market to centralized market. And what the further question is saying is just that it's like patient people that are pricing that asset. Why do I put this equation? Because you see that here it's like the price of bonds is it completely adjusts for inflation. So it's not that the channel through which inflation has an impact on borrowing and lending. It comes really from the fact that it's like from the first two equations, you see that inflation will have an impact on capital accumulation. And then given that it's possible to show that the collateral constraint, something that is actually binding in steady state, inflation will have an impact also on borrowing and lending. we have like bunch of results that we can derive paper and pencil in this version of the model. So we will talk about the Friedman rule, and here the Friedman rule is like inflation has to be greater than the discount factor of the patient people. There are two discounts. So when I will show you the welfare results, what we mean with Friedman rule is like inflation at the BH. We can show that there is coexistence, which again hard yet in these kind of models, and where the H type will borrow the L, that will lend and the L type will borrow, and then we can show that actually. But the relation, the fourth result is maybe the more important about money and capital, that indeed what inflation does in the model is like reduce capital accumulation of both agents. So to sum up, what do we show is like increased inflation in the long run leads to a reduction of consumption in the DM market and reduction in capital and debt in the second market. And we can also show that in this version, actually, inflation and collateral debt also has like a reduction in wealth inequality, because basically what inflation does is like give an incentive, like reduce capital of the high type at a higher rate compared to the low type. But all these effects, they have an ambiguous balance on welfare. Why? Because it's like, as I was saying before, here inflation, it's a tax on transaction, tax on savings, it impacts debt. So to understand which of these channels is stronger, and to understand, we need to actually put some numbers and compute the effects on welfare numerically. And we do that using like a US calibration. So when we compute the welfare cost of inflation, what we do is like rewrite the welfare, and you will see that in our model, what inflation does has an impact on the first market EM, so because it impacts buyers and sellers, doesn't have any effects on consumption in the centralized market, but it impacts the capital income, the inflation tax, and collateral in the centralized market. And what I want to stress is also, so what we do is like, the experiment is like the standard experiment that you see when computing welfare cost of inflation in steady state, reduce inflation from gamma to, from pi to gamma, and then compute, recompute everything in terms of consumption equivalent. But it's important to stress also that in a in a representative agent setting, many of these effects won't be there. You will have an effect only on consumption in the centralized market and on capital income in the an effect on consumption in the centralized market and an effect of capital income in the centralized market. All the others will wash out. And what's important here is also to show that inflation, we can show that the inflation tax and the collateral channel are two effects that redistribute welfare gain from the H time, from the patient to the less patient people. Well, so what do we, then we do the standard exercise that you do, like go from 10% inflation to either zero inflation or the Friedman rule. By the way, I remember like when I thought, oh, this like 10% inflation, why would you ever care about 10% inflation? Then I actually experienced 10% inflation. So it's suddenly this exercise has a different, it makes more sense. But anyway, so what this table shows is our model, which is the first row. So a model with collateralized borrowing, and look at the welfare cost of inflation for society, the average, and then distinguish between low type and H type. And basically, if you just focus on the first row, what you see, we get like average cost of inflation for society, which is in line of previous studies in this literature without heterogeneity. But it matters actually to look at the composition. As it turns out, remember the question we posed at the beginning, inflation is a progressive tax overall. Because it turns out that in our model, borrowers, they do suffer from inflation in this decentralized market where they use money, but all other channels that are present in our model in the centralized market, so through capital and through, it's something that is beneficial for them. And then it's like what we do is like trying to understand how the strength of our channel on collateralized borrowing. Consider also some version of the model where borrowing is fixed at some level or there is no borrowing at all. And what it does is like basically increase what if you compare the first line with the second line, for example. So you see that collateralized borrowing decrease the welfare cost for L type and increase it for H type. But we can, but capital in this model was used only in the decentralized market. And that's again was just because of analytical convenience. So what we do is like, and that could, so what we do is also solve a version of the model where capital is a productive asset also in the second market. And once we do that, basically we show that it's like, we actually get a higher, you shouldn't say lower, average cost of inflation compared to the table I showed you before. And importantly, what happened in this model that now money has an impact also on consumption in the centralized market. Why? Because inflation will have an impact also on labor income. And through this channel, it becomes more, it becomes more more of a problem for borrowers, for the poor in our economy. Interesting, in this model also we have like a different effects of inflation on wealth inequality, because it turns out that when we can show that when theta, the maximum LTV, is high enough, what's happening now is instead it's like, so that that capital of that inflation will have a negative impact on capital accumulation of the poor people, but it will create an incentive for richer people to actually invest more in capital, because there is this portfolio rebalancing from the nominal to the real asset. Which means that for high enough theta, inflation increase wealth inequality. So I think I have 2 minutes, so so what we do is like, let me conclude. And so what we do is like build a microfunded model of money where there is coexistence of many different assets, money, capital, and debt. And that's important because then it helps us like capturing many channels through which inflation can have an impact on wealth inequality and welfare that usually are considered separately in the literature. And we show that inflation is indeed detrimental to capital accumulation, and that the expected inflation affects borrowing and lending through this collateral channel as an impact on wealth inequality. But when we, to answer the question from the very beginning, inflation remains a progressive tax, so it's like something that is worse for richer people. But we show that it's like, so is this a robust result? We show that a way of reversing this result is assuming that actually, even remember, like that even in the decentralized market, there is a probability, there is a random probability of using credit as a means of exchange. Once we do that, and if we assume that it's like richer people who have a higher probability of accessing to credit. Why? Because in the data we know that it's like usually they are the one with credit history so that they can use credit cards. That would be a way of reversing the progressivity. And I think I'm done. So thank you. Yeah, we have some extension like looking at alternative pricing mechanism and looking at the effects of unexpected inflation in a full Hank model, but that's like future work. So thank you.
Thank you very much, Daria. The discussant is Victoria Vanasco.
Well, I want to thank the organizers for inviting me to discuss this paper. It was fun to read. So what they do in this paper, they're trying to understand a very, very topical question, which is what are the welfare effects of inflation? And let's think of expected inflation, things that we can write prices and contracts on. And what they do is they're going to have a monetary model, and the contribution I think that they bring to these models is that they're going to introduce heterogeneous agents in the sense that they have heterogeneous impatience levels and collateral constraints. So the heterogeneous impatience is going to give rise to agents to borrow and lend, and collateral constraints are going to affect how well they can do so. And the main finding is that inflation is going to disincentivize capital accumulation, and this result was sort of known for a paper that they cite quite a bit. But the contribution of this paper is to show that if you, in the context of heterogeneous agents and collateral constraints, this can tighten the constraints of borrowers and can lower wealth inequality or increase wealth inequality, I guess, in the extension. But it has important effects, I guess, for wealth inequality. So I'm going to use a toy model to explain. I mean, it was very nice how you also had these first order conditions. I'll do something very similar, and then I'll bring my comments. I just want to highlight the main mechanism. So you have agents that are patient and agents that are impatient. So the patient agents just have a higher discount rate. And let's think of a 3-period model where basically agents are going to make all their big decisions at time 0 and time 1. And then DM, it's an important period because think of this as the period where agents just go to a market where you can trade only with money, okay? And then they just go back to CM1 and they do what they were doing before. So, everyone enters this period with money, capital, and debt, okay? And they choose how much to consume, how much to work, how much money to bring into the DM period, capital, and new debt, okay? And then what happens here, this is just a market. So it's very nice. Now, I think the intuition of this is like money is something that we can use in certain markets. And so if we want certain goods, we can only purchase them with money. So in this market, all that matters is how much money sellers are going to arrive with and how much capital the buyers are going to arrive with. Whether you're a seller or a buyer is random. And really here, all you have to think about is if you're a buyer, how much do you want to buy, given the price, okay? So the key thing is that there's a stage in which only the trade for a consumption good happens with money. And then there's the final period where, again, the agents enter with money, capital, and debt, and they choose how much to consume and work, okay? So then where is money supply coming here? Let's think that there's a government that supplies money M in period 0 and money M prime in period 1, and inflation being the growth rate. So everything here, it's in terms of, the numerator here is consumption in period CM1, okay? So, if you think of the last period problem of the agent here, so I'm doing this sort of in backwards induction, it's super simple because you have these quasi-linear preferences. I put log, they don't use log, but I thought it was easy for me. And then you have this budget constraint, right? You want to consume, you have to pay your debt. This is how much you bring into this period, your capital and your money. And whatever you don't, if it's not enough, you have to work. Because of quasi-linear utility, agents here will always consume 1 in period 0, in period 1. So this is actually very nice. And then it's very easy to pin down labor. It's just, given by the binding budget constraint. So, so that simplifies the problem a lot because really then all you have to think about, agents really have to be concerned about how much money, capital, and debt to bring to each period. And then there's this intermediate stage where it's the market where you trade with cash. And the key thing here is that there's this constraint, right? So you can only trade with cash. So whatever money balances you bring into this period, that has to exceed the amount of goods the agent wants to buy times the price, okay? So I'm going to suppose that these constraints always bind, okay? So then that means that, how much money you bring in determines how much you can consume. So, if you happen to be a buyer, what that means is that you'll get to consume, but then you'll bring zero money to the last period. If you're a seller, it means that you can accumulate money. How much more money you'll bring into the last period, it's a function of how much you can produce, and this is why capital is important. And then a very important equation, I think, for understanding what's happening is the market clearing in this market, no? So we have a fraction row of impatient agents. This is how much they will demand. It's their money over the price. This is how much assets they could produce if they were being sellers, and the same for the impatients. So just by looking at this equation, we can see that if any of these two agents brings less money balances into this market, what has to happen is that the relative price of the good in that market has to fall, okay? So this is sort of the main thing. If you bring less money balances, there's this asset whose value will fall, this good. And what that means, if we look at this, is that the marginal value of capital then will also fall. And this is really the mechanism through which inflation, which I'll come back later, might affect how much money balances you bring in, is going to disincentivize capital accumulation, okay? So this is really the role of this stage, okay, to reduce the marginal value of capital when money balances are lower. So then we go back to the first stage, and this is really where you sort of get a clear view of what's happening. In addition to consumption and labor, the agents in the future, with some probability, they'll get to consume in this money market, DM market, in which case they lose their money. And if they're buyers, if they're sellers, they get this extra income, and then they have their capital, their money, and they pay their debts, subject to a budget constraint, and very important, this collateral constraint, okay? So, we know that consumption will be one, labor is determined by the binding constraint, so then really it's looking at, what are the payoffs of each of these assets. So Daria explained this really well, actually, so I'll be quick. But first, if we think about money, I think the cost of money is inflation, because you have to lose sort of pi units of consumption to bring 1 unit of consumption to the next period. And then, but what do you gain? That in the future, if nothing happens to you in this market, you'll get that unit of money at the final period to consume. But if you get lucky, you can get this surplus. This is what she called the liquidity premium, the fact that you can consume in this intermediate market. Now, from here, it's very clear that if inflation goes up, the cost of bringing these money balances increases, which means that prices will have to fall to clear the market, okay? So then we go and we look at the capital. The cost of capital is really 1 unit of consumption. What do you gain? Well, you can bring this capital into the future, and if you're lucky to become a seller, you get the marginal product of capital, okay? So again, and then also it relaxes your constraint. So, just from looking at this, it's also very clear that if the price of this asset that it's traded in the DM market falls, this equation has to be satisfied. The incentives are just to invest in less capital. And then there's the final, which is how much debt they bring in. And here what we can see, the benefit is that you get 1 unit of consumption and that it relaxes your constraint, and the cost is just how much you have to pay. And here you can see that always it will be that the impatient agents are the ones that are going to borrow and are going to be constrained, while the patient agents are not. So, it's immediate then that because of these low agents will have less capital, which means they will borrow less. So if we think that we have agents that were borrowing just to consume and now they can borrow less, that's going to reduce the wealth inequality, right? Because before one was sort of, this saving and the other one saving, and now they can do so less, okay? So in that sense, so it's not surprising, I think, that inflation tightens the collateral constraints of borrowers, because we already knew from the literature that high inflation reduces incentives to capital accumulation. So I think a big part of this paper is to really quantify and understand the welfare implications of doing so. Now, one thing I was wondering is that here inflation reduces wealth inequality, at least in this setting, not because agents are borrowing to consume. And I was wondering how much of this would change if agents were instead borrowing to invest in productive assets, for example, that could bring their ability to accumulate capital in the opposite direction. So I think it would be useful to discuss the robustness to modeling assumptions, which you also do to other modeling assumptions, right? Like having capital in the second period and whatnot. But this one to me seemed important because here you're really borrowing to consume. So it's a very special case for borrowing. And then my last comment, there's a lot of discussion in the paper, well, not a lot, but there's some discussion on the trade-offs of high inflation, as if like it could be good or bad, but I didn't really follow those trade-offs. So one thing that it wasn't super clear to me is, okay, if you tighten constraints, in which sense could this be welfare increasing? Or, you know, if there's higher inflation, in which case this could be beneficial? And I think to understand that, it's important to use the model to maybe highlight some of the externalities. The model does have frictions, clearly, but I struggled a bit to understand that. And then, you know, if you look at this decomposition, nice decomposition of welfare that you do, clearly money is only used in this DM market, right? So it seems like the welfare losses will be from the DM market. Because you have less money, you're gonna bring more things to the other markets. So it seems sort of reasonable that you have this redistribution from one to the other. It should be suboptimal though, that's my prior will be, because you know, you wish you could bring more money balances. So yeah, I would maybe discuss more through the mechanisms through which any of these things could be welfare increasing. Then of course you can quantify the welfare losses. And I think it's nice to highlight that when capital has this feature that it can be used to collateralize debt, the effect of inflation is not as bad. I think that's a very important result. So it's a very topical paper on the effect of expected inflation. I think that the contribution, at least the way I read it, is they really want to highlight the importance of considering borrowing constraints, and they highlight this new type of redistribution. Because we know of other types of redistribution between borrowing and lenders when inflation is unexpected. This is a completely different type of redistribution. I do think more work is needed to really disentangle these forces, if they exist. Maybe not, maybe it's all negative, but yeah, thank you.
Thank you. Should we give her a chance to answer? Then I take the question.
Yes, maybe if I can answer just so thank you a lot. I mean, your graph was even better than mine, so that's like, and I wish I wouldn't have spent time to I would have borrow yours. And it's like, yeah, I think it's we have to explain better different channels, and it's like idea of an extension of having borrowing to invest in productive assets seems a good. The only thing I want to say is like why tightening constraint is beneficial, because it's like, again, here it's really important that the fact that we're looking at the welfare in steady state. So it's like tightening constraint means that at the end they will have to pay less interest on their debt, and that has like a positive effect on they need to work less so that's the effect through which tightening constraint is actually something beneficial. Then of course if you start look at think of the effects of inflation in the transition to this steady state, it's different because tightening constraint won't be something that's beneficial in the transition. So it's really that we look at the steady state.
So maybe one comment on a reference. There was this very nice paper by Alan Overback at the NBR annual where they got, I don't know from where, information of all assets and wealth in the US, but then they also incorporated all possible tax tricks that one has and Social Security and so on and so forth. And they did this shock of inflation and then trace over generations the impact on inequality, which probably has a lot of moments and data that you can use. I was impressed by the detail that paper had and also how they play with all the tricks one has. So that's just a reference. But going back to the tricks and perhaps picking up on something that the discussant mentioned, so at least in Latin America, the evidence on the effects of inflation is that increases wealth inequality. In fact, getting rid of inflation in Brazil is what actually helped bring down inequality and wealth inequality. And if you go and look at the experience in the US, this round also, if you had a house, you became very rich, depending where you were. So I don't know if this is related to what the discussant mentioned, that consumers are borrowing to consume, they could borrow, as you said, to invest in productive capital, but usually what happens is that you invest in unproductive capital, which were houses. And so perhaps extending that, yes, like this is, you go to Greece, you go to Spain, everywhere, that's what people did. They bought many houses. And in Latin America, it's the same. The process is then you got poverty and inequality. So just to think about that in terms of the robustness of results.
Thank you. So my comment was also like along these lines of that Victoria made about productive capital. And I think it might be even especially important to have heterogeneity in the returns of this capital, because also what we know is not even like having the fact that some people are more productive and they might get more return on capital. So also like inflation might have not only wealth inequality implications, but also efficiency implications that can then feed back also on wealth inequality. So I think this would be interesting to understand.
Just a quick question. How should we think about theta in your model? Because if I understand correctly, shouldn't it actually decrease with your endogenous? Because if there is less capital available, if there is less indebtedness, less risk. So in the sense, theta might actually go in the other direction.
It's a parameter. So it's just like, so it's just, theta is just a parameter. You might endogenize the contract and have like theta days, but here it's like, and it's a parameter. Think of a macroprudential authority that fixes the maximum LTV. So it's that's how we think of theta. And then in terms of wealth inequality, I just want to say that actually the decrease of wealth inequality, it's in the very simple model where capital is used only in this money market. It's not a money market, but it's like, but it gives an idea. It gives a good idea. If capital is productive also in the centralized market, then we do get indeed that it's like inflation can, which I think it's. Yeah.
Which is what we used to call investing in houses.
Yeah, no, that's a good point. And then to better is heterogeneity in the returns of capital. I think it's a good extension, but here actually we kill all the heterogeneity in the centralized market, and we try to have. So we assume that people invest in different level of capital, but then capital is aggregated and used in production, so the returns are the same. Should we do that, then it will create also like we will have to keep track of distribution, and we would have also wealth effect on money demand. That's so interesting, which is an interesting, of course, extension.
If I can just add one question on the collateral tax. So this is the impact of inflation on investment is through the fact that this is productive collateral, right? But if you had unproductive collateral in the form of bonds, that would not, so the increase in inflation would still reduce consumption, but that would not lead to a reduction in the collateral assets, therefore also from that. So I was wondering what the implications and the robustness to that.
No, yeah, so what the robustness that we do is like, in general, is like whenever you have a borrowing constraint that is not linked to the productive asset, then all these effects on borrowing and lending of inflation will be gone. So inflation will still be something that is painful in this model, but it's painful for the usual reasons of this literature, which is that it has an impact on how much you can consume in the market, but it won't have any redistribution between borrowers and lenders.
Thank you. So let's move to the next paper.
Yes.
So the next paper is on redistributive trend inflation shocks, and presenter is Evi Kappa.
Is the hair okay?
Yes.
Okay, good.
Perfect.
All right, so here we are. So you listen to some theory. Now I will show you the data. So what we do in this work, which is joint work with my two students, Sebastian and Alejandro, is that we are going to try if this would work, but it doesn't. We're going to try to see what are the effects of inflationary shocks. And you know, we are not the first ones. There are many people that they have looked at the effects of like monetary policy, that it creates inflation, and they have looked what kind of retributive effect they have. But you know, they didn't look at kind of permanent shocks. So that's what we're going to look at. We're going to try to look what are the effects on the redistributive effects of trend inflation. So to do that, what I'm going to do is that I will follow a very simple method, like approach, in which I will identify innovations to trend inflation using a simple trend cycle decomposition. And then I will take these trend innovations that I'm going to identify. I will tell you why I call them innovations in a second. And I'm going to try to see what kind of macroeconomic effects they have. And then I will go to the CEX data and actually also to the DFA data. And I will try to see how these innovations affect first consumption to try to understand the distribution. And then I'm going to talk to you about what happens with the financial asset of agents. So it's going to be connected to what Daria was doing. I'm afraid the results are completely different because the paper is called regressive trend inflation, so it is not progressive. And but I will show you that Daria has a point, okay? So I will do that. That's why I didn't make comments before, because I will come to the comments here. So, what I'm going to do at the end, and I think I will have time, is that I am going to tell you not only about these generic innovations, I'm going to try to give them a name. Because, you know, these kind of persistent shifts in inflation, they come from somewhere, you know? So what I will be able to do with my data is to identify like two sources of trend inflation. One is going to be monetary policy and the other is fiscal policy. And I'm going to show you how these are affecting redistribution. So this is my plan, and going according to plan. Daria did a good work to talk about what people have done in this literature, but I would like to get you in again, because I don't think she talked about some of the channels. So, when I have inflation, inflation can affect my earnings, okay? So if I am a worker, then I usually am subject to some wage rigidity, and this can affect actually my real earnings when inflation hits. But this should not be so much important for the long run, because in the long run, wages would adjust. But at the same time, it could be that I get my wage and I don't have any other of capital assets, etc. So in this case, inflation would matter. This is the earnings heterogeneity channel. Then I have what Daria talked about, the wealth channel. So one is the channel that comes through revaluation effects that Daria is talking about, which is how much the borrowers and the lenders lose from inflation, and I'm going to come to that. And also what she talked, and I think Laura was trying to talk about also, which is the asset holdings channel. So I hold some assets, and inflation, persistent inflation, can affect the value of these assets, and this is another way inflation can be redistributive. And finally, we have the expenditure channel, in the sense that, you know, I am consuming some goods and I like to buy Gucci. And if there is a high inflation, like from 2% to 4%, it doesn't matter for me because I can afford it still. But like somebody that buys Zara and there's inflation because his income is such, then the effects are going to be different. So depending on the basket of goods I'm going to consume, the inflation will affect me differently. So this is the expenditure channel. So I am going to try to incorporate all these channels in the analysis. I'm doing data here, okay? So I will give you the main findings. If you don't feel like, you can switch off and answer some emails. What we are going to have is that these kind of trend deflations in the aggregate, they will look like supply shocks. They are going to create a contraction, which is going to be also inflationary, and they are going to decrease consumption. Now, when I'm going to go to look at the different agents in the economy, what I'm going to figure out is that the poor are the guys that suffer the most. Now, why they suffer the most? Because they lose in terms of income, especially labor income. Then they are not losing in terms of revaluation because, according to what Daria said, I also find that when inflation is going to kick in, what is going to happen is that the borrowing ability of everybody is going to get lower, okay? However, the poor, the very poor, and this we are calling it the liability channel, they're going to default. They're going to default on their debts because their real income has also decreased, and the debt-to-income ratio for them is going to fall much more than the other households, and they are going to suffer the more. While the asset holdings of the rich, as Laura said, is as if I paid here to make the introduction, is like it's going to increase because in the long run, you know, house prices are going to increase, and they're going to like to gain from this inflation. So, irrespective of the source, I'm going to show you whether this is fiscal or monetary, inflation is going to be actually regressive. So let me show you the identification. Yes? Yes.
You're going to look at the different categories of the inflation, like of the CPI?
Yes. But like it's a part which is very small in the paper. If you want, we can discuss it later because it doesn't show, it doesn't have effects. I will come. Okay, so what we are going to do for the decomposition is that we will take the inflation series, we will take a trend component and a cyclical component, and we are going to decompose it using this strange name of Stock and Watson, but it's like univariate, unobserved component stochastic volatility outlier. Basically, what you have to see is inflation is a trend and a cycle, and we are going to talk about trend inflation. We want to use long data, so we'll go back to 59 Q1 until 2019 Q4. And basically, the trend component is going to be defined as a random walk, and I will be interested in identifying this sigma delta t eta tau t. And the cyclical component is also there. I allow for outliers, so these are the ST. And then what I want to do is that I want to make sure that what I identify are innovations. So they're not explained by previous financial or macroeconomic conditions. I do the test, they are good, I will show you. Maybe this doesn't work, so I will not. So this is how the statistical method is going to decompose inflation between a trend and a cycle. So the headline PC inflation, which is what we are concentrating on, is the orange line, let's say, and the blue line is the trend estimate that we're going to get. Now you will tell me this trend is very tight. Okay, we have tried other trends. It's in the appendix, probably it's on the going, you haven't seen it, but you know, it still works. Now, I'm not going to talk to you about what are the main events, but you can see there is like an inflationary period in the 70s, the trend like picks up, and then, you know, we have like the great moderation where the trend like has much less movement than in the previous period. And somebody will jump and will tell me, oh, but every year, everything, all your results are going to come from this period, the inflationary period. They will not because it's not in my sample of CX, okay? So don't worry. All right, now these innovations are innovations like it's a statistical object. What is this, Evie? So it is a mixture of different things that shift inflation. So in order to be able to say something, to describe you what this is, I take structural shocks off the shelf of the existing literature, and I look how they actually relate to my innovations. So what we see is that these shocks that I identified, they are very much correlated with the permanent monetary policy shocks of Uribe. He uses a very different technique to get the cycle from the trend, and still we see that we get something very similar. They are not that related to the monetary policy shocks of Romer and Romer, but it looks like that contemporaneously, some of the Romer and Romer shocks are actually shocks to monetary policy that they move trend inflation. And the same for Gettler and Karate. They kind of contemporaneously move together with all new shocks, the ones identified by Kanzik, if you know the paper. They look like negative TFP shocks. I told you before that they are contractionary, and they are also correlated contemporaneously, but also with lags. With the Bianchi-Toll shock. What is this Bianchi-Toll shock? It is a shock in which they identify in a VAR unfunded fiscal transfers. So basically, our shock looks like that it can be related to different sources of fluctuations, structural shocks in the economy. You were not asking other people, but fine, yes, you can ask me as many questions as you want. Tell me. Yeah, tell me.
Do you want us to interpret what you're doing as the effects of unexpected inflation?
No.
Okay. So
For me, there are shifts to, I mean, here you have to understand, Victoria, that I'm trying to be as agnostic as possible. I want to see shifts in the trend, and then I want to see the macroeconomic effects and then being able to call them something. So I'm actually going to do that now. So how are we going to do the aggregate effects? We are going to use smooth local projections. I mean, we have experimentalized with different stuff. If I do standard local projection, the effect is going to be the same. So I'm controlling for cyclical innovations, lags of PCE, real GDP, etc. This is the XT variable. And then what I'm interested in is the coefficient that you see there, the beta 8, which is actually identifying how in different horizons, the innovation that I'm looking at affects the dependent variable that can be many things, PC inflation, expectations, GDP, blah, 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 okay? My sample here is 84, 2019. I have results for the longer sample, but given that the CX starts in 1984 Q1, I want to compare potatoes with potatoes, so I keep it this way. All right, so here you have the effects of the macroeconomic effects of the shock. As you can see, the PCE inflation increases on impact and has a persistent effect here. And you can see the more persistent effect comes in PCE core inflation. Inflation expectations also jump and they remain high for a while. So that's, now I can say that yes, this is a shock also to expected deflation somehow. And I see GDP falling, consumption is falling, and I see the 10-year rate following pretty closely the PC inflation. So I don't have any like effects coming to the real interest rate. Now, if I look at other assets and I look at house prices or stock prices, I see that they are falling significantly with some lag, or not for the stock prices, but this house prices, and oil prices like are increasing. So these are the aggregate effects. Now, what I'm going to do is that I'm going to use local projections, and Fiorella is going to tell me how much time I have. Very good. So I'm going to use local projections, and I'm going to now take the CX data and make these pseudo groups that the guy there in the door is doing. He's afraid to come in the sense that we take the CX data, and we look at the distribution of agents. We are distinguishing them between low income, middle income, and high income. Clodo, that is the guy in the door, is doing something similar by looking at monetary policy shocks with Paulo Surico. And there they are considering mortgagors versus like debtors, owners, and renters. So we will follow like a similar technique, and we are going to use the same kind of model as we were doing for the aggregate data, but here instead, we are going to consider the different pseudo cohorts that we have. So I tried to make this graph because I think it's easier for you to understand what's going on. So here you see the consumption responses of the three income groups. The blue line, which is continuous and has some shades around it, they are the shades of blue that have to do with confidence. So we have like 68% confidence and 90% confidence, and it's becoming like lighter. And we see that the consumption of REITs, which is the blue line, is kind of falling. And the middle income consumption falls in a similar way. But the poor guys, as you can see, their consumption falls a lot. And like both on impact, but like also in the medium run. So the guys are clearly losing from this trend inflation. Now, you have to believe me that this is true for durable and non-durable. I'm not going to show it to you. It is true if I'm going to use a trend for measurement errors in the CX data, or if I don't use this trend for the different groups, if I use a quadratic trend, whatever. And I can show you also that smoothing doesn't matter. The result is always the same. And I will not, because I have 10 minutes left. So let me try to explain you now why these differences in consumption patterns. So we have some guidance from the theory. Like one thing is given that there is literature about that, people would be like, Evie, what you are finding here, low income is probably associated with AIDS. It's probably associated also with housing tenure, like, as I said, Claude. But no, I mean, I can show you in the paper or later in the slides that AIDS and housing tenure will not have anything to do once I will group the different groups with respect to their income. It is the income that matters. So what can explain the heterogeneous responses? It's either earnings or wealth or heterogeneous inflation. And because Luciana is my friend, I would be able to show her that, as you can see, heterogeneous inflation is not the case. Here we have the responses of the different consumption baskets, that the inflation series that I have constructed with the different consumption baskets of the CX. And as you can see, like, there is no heterogeneous inflation response. So that's not the channel. Now, let's pray that this is going to go back. And yes, it went. So it could be the other two things going on, the earnings and the wealth and financial constraints. So I'm going towards what Daria was doing before. So let's look at the earnings. This is labor earnings from the CX, and this is the response by different income groups. What do we see here? We see that these poor guys are really, I don't want to say the word because it's life casting, but really condemned by the trend inflation shock. And this is both in the short run and in the long run. So instead, we see that the middle income guys do not suffer that much. Actually, they suffer less than the rich, which can be related to some of your arguments. So I'm not sure why this is so. Actually, I have to still understand it myself. And if I want to look at total income, the picture is kind of pretty similar. Okay, the poor are suffering the most in the long run, and not so much in the short run. Now, because total income includes also capital income. So now I will show you the next picture that you will find very nice. So here, what you see is the liabilities across income groups. So as you can see, the low income groups are reducing much more their liabilities with respect to the middle income and the high income groups. Now, this combined with the fact that low-income households are losing a lot of their labor income is telling me some story here. How can I decrease so much my liabilities when I lose income? It cannot be that I pay back my debt. So if I look at what happens at the delinquency rates at the aggregate, you will see that the delinquency rate after this kind of shock increases a lot. So let's move back, because it's not the only thing that is going on and the only thing I can look at. Look at this. This is the liabilities to income ratio for the different income groups. As you can see, the liabilities to income ratio of the very poor guys fall, and they fall like vastly with respect to the other groups. That you see, the middle income, they have to increase their liabilities. And the high income, they don't suffer that much. So this would kind of fit a bit your story. Like it is kind of, you don't have low income, you don't have these guys there, but it is true that the high income cannot borrow more. So you can see, if anything, their borrowing is falling. Anyways, so let me go back and show you the assets, why the income of the low income group is the total income is not falling that much, because their asset value is not affected so much. As I showed you before, stock prices were falling. This will affect mostly the rich in the short run. But in the medium run, if I go after 20 quarters, they recover their assets back, while the low income are still losing. Okay, so that's why I see this aggressivity, and I can see it also clearly in their net worth. So for us, the story is different from what the literature says. Like what Daria presented, what I have tried to tell you before, it is not that the low income are losing because they lose only labor income. It is also that these guys, they come up to their neck and they have to default on their debt and they are losing assets. So this is kind of the story that we want to push. And now I still have 5 minutes to torment you with a little bit of the structural shocks. So what do we do here? I show you that we had a very high contemporaneous correlation of our shocks with the non-Fisserian shock of Uribe and with the unfunded fiscal transfer shocks of Bianchi et al. So what I'm going to do now is that I will use local projections, and I'm going to use a simple local projection in which I am taking the shock of Uribe or the shock of Bianchi et al., and I'm running a local projection to see what is its aggregate effects. And now I'm going to interact this shock with my innovation. Why? Because I want to extract from the data the part of the shock that is related to permanent shifts in inflation. So that is the interaction that you see here, like, whatever you see. It is the sum of the coefficient beta h with omega, all right? And I want to see what kind of redistributive effects these kinds of shock have. So here is their aggregate effects. The black line is the monetary policy shock, the permanent monetary policy shock, and the orange line, I don't know what color, mustard color, is the fiscal shocks. So you can see both shocks increase inflation. They are affecting core PCE. They affect the 10-year yield. They are expansive with respect to the GDP per capita, the monetary policy shock. The other shock, the fiscal shock, is not that expansive. And actually, if anything, the other shock is also reducing consumption, and house prices are not affecting. These are the aggregate effects. Now you will be a bit confused. You will be like, but Evie, before you said this was a permanent shock. You have to understand what is the exercise here. I take the structural shock of these guys and I try to extract the permanent component to inflation of this shock. So my results that I show you so far, they're not directly comparable with what I show you now, okay? So don't ask me afterwards, I explain. So, good. So what do we have in the case of redistribution? So here we have the same colors as before. The red are the poor. It's like communism, let's think like this kind of colors. And the blue are the Pepe. Like the blue colors are the right-wing party of Spain is blue, so I thought it would make some correspondence. It's the same in Greece, actually. And what we see is that high-income households, actually, after a permanent monetary policy shock, are going to increase their consumption, and the same for middle income, while the low income cannot. They stay flat. And if I look at the fiscal transfer shock, I think that this is very important. I'm saying something to the policymakers, they should listen to me. Like, I have a fiscal shock. I'm trying to help the poor, okay? Look, I'm helping them at the beginning to sustain their consumption. The rich are losing. But in the medium run, this reverses, like it kills me back. It's not good. That's not a good policy to follow. I'm creating inflation that is also regressive. And although in the short term, I have some benefits. Maybe this is something that our policymakers should learn. So, and here, what I do is like to just show this stronger, is that these are important effects. Like you can see, like the fiscal transfer, it is regressive in the short run, but then it's becoming, it is progressive. Yeah, it's becoming regressive. And if I would plot you more quarters, you'd see it better. But I thought to keep the presentation short. So yes, that's it. What I wanted to tell you today is that I wanted to find a way to identify this kind of shifts in trend inflation. And believe me, it is not very easy to do it. You come with econometricians like Sylvia Kerkorth or Giovanni Rico, whatever, and they jump on you and they say, oh, they know this is not easy to do. So we do it, and it is convincing, and we do have a shock. And then once we have a shock, I am telling you about what is their aggregate effects, and then I go and I'm able to talk about the distribution. And moreover, I don't stop it there. I don't talk to you about to use something generic, which is contractionary, but I go and I tell you something that is relevant for policy, which is like what kind of policies that they create this kind of shifts, can generate these shifts, and how these shifts can affect actually the redistribution of agency in the economy. And thank you very much.
Thank you, Evie. The discussant is Veronica Selesneva.
I don't know how to get the show. Yes, you want? You know, you look taller now. It's good. If I sit down.
Right. Hello, everyone. Oh, actually, given that we are all here, let me just do this. Okay. Thank you. All right. So, first of all, thank you to the organizers for inviting me to discuss this fantastic paper. So again, as Daria mentioned, and showed you a few pictures, it's an extremely important question. Everyone cares about it. The public cares about it. And also, so these guys, they actually ran a survey of just people on the street and what they think about that, right? Is inflation regressive or progressive? And surprise, surprise, most of them are actually New York Times readers, I suppose. And so they say that, well, actually it's low-income people, the poor people, who are more likely to lose from inflation. And the way they think is actually very nicely organized by John, right? That, well, they do believe that because of the gas prices are very salient, and because, I mean, the poor spend larger share of the income on stuff like that, they're gonna suffer more. But we as economists, we are much more fixated on other channels, right? And as Eva and I mentioned, that while we do believe that inflation might be progressive because it erodes the real value of the debt. And then the next step in the, was probably this Del Canto paper, very recent one that shows that, well, actually it is the source of the shock matters, right? So if you're talking about oil price shock, it's going to be regressive. If it's a monetary policy shock, identified like Kotler-Karadi, for example, it's going to be progressive, right? And so Evi's paper makes, if you think, the next step or kind of in the other direction, right? And says that, well, it's not about the source of the shock. It's more about the persistence, right? So once you're able to identify a truly permanent or persistent shock, then the source is going to be irrelevant and the shock just going to be regressive. So it's a very important paper. It's a lot of new results, a lot of new channels. Okay, so the one thought that kept being in my head when I read this paper was, well, how about the recent episode, right? For once, it's because it's huge. We are living through that, but also because, as I think Laura mentioned, there is now some empirical evidence piling up that actually inflation is progressive, right? So people studied this episode using this fantastic data set that now combine both wealth and consumption data, both for mostly for European countries. And so they find something which is in line with more conservative, let's say, that way mainstream research, right? Starting from Dobke and Schneider, that, well, actually age is the key. And so this channel, the revaluation channel, is actually more important than other channels, right? So it creates a larger contribution. And that's because over age, we tend to accumulate nominal assets. And with high inflation, it's going to just devalue the value of this asset. However, this paper finds something different. It finds that age is actually relevant and trend shock going to be regressive. And so I find it hard to reconcile these findings. I'm not sure I fully understand what drives this result. I understand that Evie, again, disclaimer, she doesn't study this episode, right? Her sample actually ends before that. I want to know more about it. And I guess implicitly what they think is that, well, the main channel is, as she said, right, is a financial distress or default channel, let's go that way. And so I think they also look at the picture of the recent increase in delinquency rates on credit cards, on mortgages, on auto loans. And they say that, well, that's because we believe that trend inflation shocks are a key driver of these changes. So I think implicitly they tend to view this recent episode as an episode of permanent inflation. However, the current sample actually ends before that, so it would be as an extension just to see what your model tells about it. But again, as Evie mentioned, it actually might be tricky, right? Because there is now a paper by Stephanie and Martin that uses a slightly different or very different, but in a similar trend cycle model to identify permanent shocks. And so where they say that it actually really matters which sample you use, right? So if you use a post-war sample, then you're gonna find more likely that the recent episode is actually the result of permanent inflation. It's because the sample might be dominated by what happens in the 70s. However, if you extend your sample to an earlier period where there is a lot of volatility in inflation, so the model is more likely to assign this recent change to a temporary shock. All right. So the next thing, I think, because the contribution of this paper is actually identification of new shocks, right, of these permanent shocks, so I think I really would like to know more about it. So if, for example, something simple like variance decomposition might be super helpful. So if Martin's paper is of any, it's a hint of what we might find is actually, so they find also in a similar trend cycle model that 45% of shocks, right, of changes in inflation are explained by permanent monetary shock, 28 by permanent non-monetary shock, right? So we're talking about 70+% of permanent changes in inflation, right? Just to get an idea. And also would be nice to understand what exactly drives those, right? So if it's not monetary, permanent monetary, then it can be, as she mentioned, Bianchi fiscal shocks or oil supply shocks. So it would be really interesting to get a better quantification and also how much of the variation left unexplained by this type of shock. And also because everyone else uses Göttler and Carradi is like a standard in our profession, and because Del Canto use this type of shock and they got different results, it would be super useful to understand what is the decomposition of their shock, right? So are we talking about mostly persistent or not? So she didn't talk about oil shocks. I have a feeling, so I come actually from energy, right? And so we tend to believe that OPEC supply shocks are not really permanent. So, and also in your paper, right? So you show that the original shock and the one that is interacted with yours, that is actually quite short-lived. So there is a better way to do that, right? So you can do something because oil prices hopefully are actually observed. Okay, so the second question is about aggregation. So what we have seen is a separate IRFs for, I don't know, for consumption, for labor, for debt to income, for wealth, etc. So, and they're super useful. They provide a lot of information in this reduced type of way. But unfortunately, in order to be able to truly say that inflation is regressive or progressive, we need to somehow merge it into one sort of composite wealth change. And so someone mentioned this, because you find like huge effect on the asset prices, on stock market, on houses, that's gonna affect who owns this asset right now and who's gonna buy or sell this asset, right? So if I'm currently an old person living in a huge house and I need to sell it and the prices go down, right, that's gonna affect my welfare. And so I don't think currently we are able to quantify this effect. So it would be nice to have this certain welfare, monetary welfare change. And there has been some fantastic advances by Del Canto, Fagenberg, starting from Baclair, right, that now allow for a, let's call it envelope theorem type of exercise when you do not need to specify the entire model to be able to answer this question. So the last small thing is about, because your sample is large, right, from the 80s to the very recent period, actually, if you look at positions of the household sector, right, which define the strengths of the revaluation channel, they actually tend to move a lot. So here, so I took this picture from Filippo Papalotti's paper. So here he shows you the position of the household, the rest of the world, and of the government over time. So this is a net nominal position as a percent of GDP. And so here, so in the middle, this is the household. So basically it says that somewhere here in the middle, the household sector was actually pretty much balanced, which means that the valuation channel overall gonna be just exactly zero, whereas before and after the household sector is actually a net saver. And so that's gonna imply some scope for distribution. Okay, so to summarize, that's I learned a lot reading this paper. It's super interesting with the state-of-the-art methodology, and everyone really wants to know the answer. So I think you're gonna have a lot of coverage in the media once you finish this paper. It also, from economic perspective, it highlights the importance of looking at the persistence of shock, which hasn't been done before. And I'm not a policymaker, I don't work at the bank, but I think this paper humbles us in the sense that now we not only need to understand the origin of the shock, we also need to understand the persistence of the shock in order to react accordingly. So it's a very hard to swallow. Thank you so much.
Thank you very much. You want to
Is this
reply?
okay?
Yeah.
All right. So I wanted to say something that I didn't say at the beginning, and I should have. You know, Veronica didn't receive any kind of paper, so she did this discussion based on an older version of the paper and some slides. So I apologize for that, and I thank you very much for your very generous discussion. So let me try. Can I try to answer? Okay, Papa here. So let me show you the slides that they didn't show you. So let's move to age, because you know this thing is has so many loose ends. I was getting crazy with this paper, so but now I have it. I think I have it okay. So here we are. If we look at what happens like to the different income groups, age groups, what we're going to see is that you see the consumption of the young. Here we have the middle income, here we have the high versus low income, and here we have the high versus middle income, like the relative consumptions, okay? So as you can see, it is true that it is income for the young. But if we want, and the second line is middle income, but if we move to consumption of old, you can see that all the old guys are kind of doing better, but it is mostly like the high and the middle income old that they're doing better. So age is relevant. What I say is that it is income is more relevant. So age, like I don't think that there is kind of any kind of, I think age is very relevant. Now, I will extend the sample. It's a very good suggestion. And look what happens to the recent episode. Then another thing that you say is like, what about this time? What about cyclical shocks? So what I wanted to show you is, yes, these are the liability responses to a cyclical innovation. So this is a shock to inflation that happens today but dies out, so it's not persistent. So as you can see, in this case, the liabilities of everybody goes up. So it is like the persistent shock versus the temporary shock have very different effects in the liabilities of the agents. And you can see like here, the poor are not different than the rich. They kind of like increase their liabilities the same way. And here I'm doing it like whether I have a trend or not, but like, here's using CX data, and this is using the financial distributional accounts of the US data. And here you can see poor and rich are similar. It's the middle income for the DFA data that they look different. So like the channel through the persistent versus the temporary shock is different. Now, the issue is that this time, the latest paper that they're out to my reading is that this time was different. Was really different, and many things were going on. So I don't think that we can compare it to historical episodes of other cyclical inflation shocks. So about the decomposition, thank you very much for bringing it in. We have done it. So our shock is 28% of our shock is the permanent monetary policy shock of Uribe. I didn't have time to put it in draft, you understand. I haven't looked yet at the fiscal shock. So, but 28% of it is the permanent monetary policy shock. Oil supply shocks, you know why they're out of this draft? Because they're not important. When I look at how they affect inflation in the long run, they don't affect inflation in the long run that much. So besides the fact that they are correlated with my shock, it doesn't look like that they have a permanent effect on PC. So that's why it's out. I will look at OPEC to see if this changes, but like the ones of Kanzik, no. About the welfare change, I think that I will leave that for the next paper. Like, I think this paper has already too much stuff, but like maybe if the referee insists, whenever the paper is ready, I will think about it. And definitely I have to do some sensitivity analysis because you're right. The channel here comes a lot through asset holdings, and given what you showed me, that asset holdings are changing, I should probably cut the sample at 2000 and try before and after. Yeah, I can do that.
Yes.
Whoever you want.
So my people tend not to do many things well, but they sometimes learn, and Latin America learned that inflation is regressive. And I want to say it. No, Argentina, no, or Venezuela. So some Latins learn, and I want to say this because now that the Europeans and the US have rediscovered inflation, I tend to go to this where these facts are coming. So for example, Stefania's paper. Yeah, but people dislike because they know they're paying for it. And the evidence that Latin America learned is that the first central bankers that increased interest rates were Brazil, Chile, Mexico. They didn't even think about it twice. They know it's regressive, it's the poor people, but by the way, in Latin America, it also killed the middle class. We don't have middle class. So one thing to keep in mind when you start having a lot of inflation is that you get a lot of indexations. People tend to think only on wage indexation, but you start indexing assets, interest rate. Like in Brazil, you can index anything you want on inflation, exchange rate, so on and so forth, and that complicates a little bit more. The other thing is to keep in mind that the US is now a net exporter of oil. So for the US, the shocks actually now go the other way. So it may be not per se that all shocks don't matter as much, is that for the US, they're now positive because the US is now net exporter. And finally, I found very interesting your result that what is happening is that the poor default, although I thought the poor didn't have a lot of assets to be defaulting on, but they're defaulting. And we tend to think that that has additional costs that are not picked up in the data.
Thank you very much. I just want to say something that I didn't bring today because I did the slide like last minute. I do see that used car sales is like increasing like crazy after the shock. So like they don't have a lot of assets, but whatever they have, they sell it, like cars, you know, they cannot pay back. The poor. Yes.
Evie, nice paper, thank you. I have a question to see your impression. What would be your policy recommendation? What you said about the fiscal transfer and so on really resonated. What would be your, what would you recommend? The second comment is with the oil. You may want to check because I think in the US, there is a bit of a subsidy, in terms of the gas prices and so on. So maybe that's why you don't get much of an impact. It is a result that maybe at odds with what people have found. And then I really like the idea of what your discussant said about the variance decomposition. I don't know if you tried to use the method of the paper by the last name that I cannot pronounce, Mikel. Is the name Ploborg, like it has a very nice paper. Maybe it could be worth checking it out. I don't know how easy it is to implement, but could be doable.
Shall I answer? So actually, the policy recommendation, you know what to ask, eh? But I think it's easy. No, it's okay. Like, I'm not that wise to know the policy recommendation, but like, if I were a central banker, what I would do is like to keep a good eye on long-run inflation expectations, and when I see they are drifting, not wait, not making the mistake, act fast, so that I don't let any kind of these deviations to occur. That's what I would do. Now, regarding the second point, I told you I did this decomposition, that monetary policy shock of Uribe is 28% of my shock, but I haven't done it for the fiscal shock to tell you how much. The rest is something else. So, but I have to look still what it is. Victoria, should.
It's a follow-up, I guess, on Laura's point, because I wasn't sure what you were trying to say. So the fact that the poor people default more, I think that's a super interesting fact, but the way I see that, that's an insurance mechanism. It's a good thing for poor people to be able to default. It increases their assets, but they're lowering their liabilities. So
it improves net asset position, but that is costly, and that's
no, exactly, and that's my point. So on the one hand, it's a good thing, but then the question is maybe you can't access the borrowing ever again, and then that might have to examples. But I did see what you showed.
Perfect.
Yeah. How that's
No, I did show you guys that I didn't probably highlight it enough, but look, the guys in assets, of course, they are not losing that much as the other, but in the long run, the net worth of these guys goes really very, very low. So like, that's exactly what I mean. Like in the short run.
That's not because of the default, I'm saying. It's not clear why defaulting should lower your.
No.
Right. Well,
It's a fall in your real income that makes you default, and this somehow is affecting like your future wealth path. That's what I say.
I think we can continue the discussion.
Yes.
We have a break now.
Thanks.
Until
Thanks a
10:30.
lot. If you want to partir yourselves. Yeah. ¿Qué te pareció, señora?
Just 1 second. The break now is in the same place as it was before, on the stairs, okay? At the top of the stairs. Back at 12:30, yeah. Well, we'll let you know when we have to come back. Thanks.
Okay. Welcome back to the continuation of the conference. Ladies. So welcome back. We're going to start the last session of the super interesting and intense program of this conference. This last session is on climate risk. So we're starting with the first paper on measuring climate risk exposure to insurance, Hye-Young Jung.
Yes. Okay, all right. Thank you so much for having me, and thanks all for staying until the very last session. My name is Hye-Young Jung, and I'm excited to present my paper, Measuring Insurers' Climate Risk Exposure. This is joint work with Rob, Sean, and Sharon at NYU Stern, and I'm at the New York Fed, so the usual disclaimer applies. So understanding the impact of climate change on financial stability is a very important question for researchers, financial institutions, and regulators alike. And insurance sector is one of the key financial sectors, and they can be exposed to climate-related risks through their operations as well as their $12 trillion asset holdings. For instance, physical risk can affect insurers with higher than expected claim payouts, and transition risk can affect insurers' investments, for instance, in a fossil fuel industry. Just to be on the same page, physical risk comes from damages to properties as from extreme weather events and also changes in climate patterns. And transition risk comes from changes in policies as economies move into less carbon-intensive economies. And credit rating agency AM Best views that insurance sector is not ready for the challenges coming from climate change. And despite of the importance, measuring insurers' exposure to climate risk is challenging for multiple reasons. So first, analysis based on the past climate events may not effectively capture the changes in the perception of risk. And this is because market expectations can change without a direct experience of climate change events. And asset prices today can reflect the changes in the future climate risk, even if the damages are decades away. So to this end, we use market-based methodology that allows us to fully incorporate changes in market expectations. And second, climate risk itself changes over time, and how firms, financial institutions, and market participants respond to the perceived risk also changes over time. So to this end, we estimate our model dynamically. We allow for volatilities and correlations to be time varying. Lastly, data gaps and timeliness have been pointed out as one of the key challenges, and our methodology only requires publicly available market data, and we estimate our model on a daily basis, so we hope that our measure could be useful and timely. So in this paper, we use a market-based approach to assess the resilience of financial institutions, insurance companies, to climate risk. And the methodology involves 3 steps. The first step is to construct novel physical climate risk factors that goes down in value when the perceived risk goes up. And once we have this climate risk factor, then we estimate time-varying climate beta of insurers. So each insurer's beta will capture the insurance company's stock return sensitivity to the factors that we constructed from the first step. And we use dynamic conditional beta model so that beta can vary over time. And once we have the beta estimates, then we can compute the systemic climate risk, which we are calling C risk. And the C risk is defined as the expected capital shortfall of insurers in a climate stress scenario. And we apply this methodology to large US insurance companies to understand their risk exposure. And here are the key findings. First, on the property and casualty insurer side, the P&C insurer side, we thought physical risk would be the primary risk for them. So we thought about their physical risk exposure. And we find that in a physical climate stress scenario, the largest P&C insurers have seen either very small capital shortfall or even excess capital reserves. However, on the smaller side, smaller insurers seem to face greater physical risk, so it seems that the risks are concentrated on the smaller P&C insurer side. Now let's think about the life insurer side. Life insurers have huge corporate bond book on their asset side, and they can be exposed to transition risk if they are investing a lot in fossil fuel industry, just for example. And we find that life insurers' climate beta went up sharply during 2019 and 2020 when the fossil fuel prices collapsed. And that was also the same time when the attention to climate change went up substantially. And in terms of the magnitude, we find that the aggregate marginal transition C risk of life insurers went up by $70 billion. This is about 13% of market cap. And this is lower than the banking sector, but we still find that this is non-trivial. And in validation exercise, we find that P&C insurers having greater operational exposure in risky regions have higher physical climate beta. And life insurers having a lot of brown bond exposure have higher transition climate beta, which adds validity to our measure. So let's start from the physical climate risk factors. We have multiple factors in the paper. And let me start from the first one, which is the P&C insurer factor. So the idea is that we construct a portfolio of P&C insurance company stocks that is designed to fall as the physical risk goes up. So how do we do this? We merge data set on the P&C insurers direct premium earned across different states. And we merge that with property damage due to natural disasters from Sheldon. We merge these at the state year level. And then we can compute insurer-specific risk, which is the weighted average riskiness of the state, where the weight is the exposure to the respective state. And we scale this by market cap to account for the size effect. So once we have this insurer-specific risk score, then we can form a portfolio of P&C insurance companies where the weight is the risk. So if a P&C insurance company is operating a lot in risky region, it will get higher weight in this portfolio. And does it work? We did some event study analysis. These are just examples. Hurricane Harvey and Hurricane Sandy were two of the largest hurricanes in the United States. And what you see here is the cumulative abnormal return of the physical risk factor that we just constructed. And this is the day one of Hurricane Harvey. You can see that before then it was pretty stable around 0, and then it fell sharply after the onset of the hurricane.
One is the day they call this a hurricane?
Yeah. And on the right-hand side, the idea is the same, but it's around Sandy. And these are just examples. We took all the largest natural disasters from 1990s to 1960s to 2000. And this is the cumulative coefficient gamma here. When we regress the physical climate factor on the shock, where the shock is the dummy variable for each day. And we control for the market factor. And you can see that it declines over time. And we found this quite surprising in the sense that the response is a little slow. So we follow New York Times headlines around natural disasters. And what you see here is the average number of New York Times articles covering the natural disasters. And we made two observations. First is that it takes time to pick up the attention. You can see that only by day 12, there was sufficient number of articles covered. And this day 12 happens to be the date that the response was statistically significant. So the idea is that the news articles respond with a few days of delay. And also in terms of content, these are the headlines around Hurricane Katrina. And this is the first day of the Katrina, and the headline was that a blast of rain but little damage as hurricane hit South Florida. And only after day 12, there's discussion of the damages and also the relief. So natural disasters impacts often seem to be not clear immediately. And that might be related to why the response is slow here. And we have more risk factors in the paper. We use true cost vendor data. They have firm-specific physical risk scores. So with the natural thing, we sorted stocks by the true cost physical risk score, and we formed a long-short portfolio. And this is our newest factor. This wasn't included in the paper that I shared, but this is the real estate investment trust factor. We have data on the REIT property holdings with their locations, and we have location-specific risk scores. We even have property-level risk scores, so we merge these and compute the REIT-level physical risk exposure, and then we can sort the REITs by the exposure and form a long-short portfolio. And the way these factors respond to natural disasters are interestingly a little bit different. But across these factors, we find that the responses are negative natural disasters. So with these factors, then we move on to measuring insurance companies' physical risk exposure. So we regress insurance companies' stock return on the physical climate factor from the previous step. And the beta here, the loading on the physical climate factor is what we are calling climate beta, physical climate beta. And these are the physical climate betas of the top 10 largest P&C insurance companies. And we see that first we see that these are moving around. So it's important to measure this dynamically. And we see that there was a spike during global financial crisis. And 2008 was also one of the worst years in terms of hurricane. So we suspect that some compound effect is going on when they are highly levered, and when they are hit by natural disaster, then the adverse effect is larger. And we find some interesting divergence here. And we are going to explain this time series and cross-sectional variation with what each insurance company is having on their insurance policy portfolio. So P&C insurers' policy portfolio is going to be on their liability side. And let's imagine that some of the policies were made to risky states, and some of the policies were made to safer state. And we want to characterize this policy portfolio. So to characterize each state's riskiness, we used municipal bond return. So for each county, we regressed municipal bond return on the same factor, the physical climate factor, and the market factor. And we obtained the county-specific climate beta. And then we aggregated that to the state level by taking the maximum value. And because we observed this composition W, we can compute the insurance company's specific policy portfolio beta. And just to give you a very simple example, if a P&C insurance company is holding half of its policy portfolio in risky state and half in a safer state, and if the beta of this state was 1 and beta of this state was 0, then portfolio beta is going to be 0.5. And we are going to compare this approach with the earlier this approach, and that's the scatter plot. So on the x-axis, we are plotting the policy portfolio climate beta by observing the policy portfolio composition. And the y-axis is coming from the market-based approach, where we regress insurance stock return on the factor. And you can see that they are positively related, which suggests that P&C insurers' physical climate beta reflects what they are holding on their policy portfolio. And we ran the regression to formalize this idea, and we find that the coefficients are positive and significant, even after controlling for insurer level characteristics and fixed effects. And once we have the betas, then we can compute C risk, and the C risk is the expected capital shortfall, conditional on climate stress, and this is function of D, which is the book value of debt of the insurance company, and W is the market cap of the insurance company, and long-run marginal expected shortfall is the expected equity loss conditional on climate stress. And K is the prudential level of equity relative to assets. We use 8% for the US, 5.5% for Europe to account for accounting differences. And the data that goes into here, this is the climate stress level. And we calibrate it to 20% because negative 20% corresponds to the tail event. It's like the 1 percentile of the 6-month return distribution on the factor. And the beta that we estimated from the previous step goes into here. And these are the top 10 P&C insurance companies' C risk. The positive numbers mean that they had shortfall, and negative numbers can be interpreted as excess reserves. And you can see that most of them are having negative C risk, which means that they were actually having excess capital. I don't have it on my slides, but on the smaller insurer side, we find that the C risks were higher. So it seems that the risks are concentrated on the smaller P&C insurers. And now let's move on to the life insurers. So let's think about their transition risk exposure. And we are going to use the same framework, but we are going to use transition climate risk factors. And we grabbed the transition risk factors from my previous paper with Rob and Dick. And we have a bunch of portfolios like stranded asset factor, which is really measuring the relative performance of fossil fuel sector relative to the market. And we have more sophisticated factors like emission factor, brown minus green factor, and some other factors that mimic green indices. And here are some examples. These are the brown minus green's cumulative abnormal return around Paris Agreement. And you can see that it falls after Paris Agreement. This means that the brown stocks are underperforming the green stocks after the Paris Agreement. And on the right-hand side, this is Trump election. And you can see that after Trump election, there was sizable increase in brown stock returns relative to green stocks. And we have full event study in the paper, but you get the idea. So now we regress the life insurer's stock return on the transition risk factor and the market factor. And you can see that it has been pretty much zero for until 2020. And there was a substantial rise in transition climate beta in 2020. And this is when the fossil fuel prices collapsed. But it's also the same time the attention to climate change went up substantially. So we extended this analysis to 1960s, and this is the only time that we see this substantial spike, probably due to a substantial rise in the attention to climate change. So we take these beta and we are going to compare that with life insurers' corporate bond portfolio. We have a very nice data set at the corporate bond QSIP level. We know what each life insurer is investing in which corporate bond. And now we want to characterize each industry, how brown it is. So to measure that, we regress each industry's stock return on the same transition climate factor and the market factor. And then we're going to obtain the industry-specific climate beta. And because we observed this composition of the life insurer's corporate bond portfolio, that's W, we can aggregate the bond portfolio beta for each life insurance companies. So we're going to do the same exercise based on this approach versus the market-based approach. And this is the scatter plot on the x-axis. This is corporate bond portfolio climate beta that comes from this approach. And this is coming from the market-based approach. And you can see that they are quite well aligned. This means that life insurers' transition climate beta reflects what they're holding on their corporate bond portfolio. And we ran the regression and we find that the coefficients are positive and significant. So these add validity to our measure. And these are the transition C risk of the life insurance companies. And some of them are having positive, some of them are having negative. But in terms of the magnitude, this is less than $50 billion. So this is not the level that threatens financial stability. And in the very last part of our paper, we show how to account for compound risk. So in the very last part of our paper, we extend the analysis to incorporate market factor, transition factor, and physical factor at the same time for both P&C insurers and life insurers. And an important consideration here is the tail dependence. So the question is, does the physical risk tend to co-move with market risk in the tail? That would be very concerning. And we've looked into that. What I'm plotting here is the x-axis is the probability of either factor falling substantially. So we move from 10 percentile to 1 percentile from the right to the left. And the y-axis lambda is the probability of both factors falling at the same time. And if we move from one-dimensional tail event, 10 percentile to 1 percentile, the tail dependence falls, but then in the very tail, the tail dependence goes back up. This means that physical risk tends to co-move with the market risk in the tail, which is concerning. In the interest of time, I'm going to conclude. In this paper, we measure climate risk exposure of life and P&C insurance companies. And we find that physical risks are concentrated on the smaller P&C insurers. And on the transition risk side, we find that life insurers' transition risk went up substantially in 2020. And in the validation exercises, we show that market-based physical climate beta reflects P&C insurers' policy portfolio composition, and market-based transition climate beta reflects life insurers' bond portfolio composition. And we hope that this could be a useful measure to assess the resilience of insurance companies to climate-related risk. And I look forward to your discussion.
Thank you very much. So the discussion is going to be done by Larissa Schaffer.
Yeah. Is it L because I have a Mac? Control L because I have a Mac and
you should be able to move here. So if you want to stand.
So thanks a lot for letting me discuss this very interesting paper. I learned a lot because, I mean, insurance is not my main topic, but I also like your other paper on banking that I read then even more. So basically, and Hyun has a very interesting paper also on banks' exposure to climate risk. So my discussion will be the following. I will not sort of go too much into depth of the paper in terms of summarizing it, because I think you did already a great job. Very well explained what the paper is about. And I think, and then I will present 2-3 comments where I was basically thinking a bit more deeply what the paper tries to measure, sort of what could be the policy implications. And looking more deeply at some of your plots, since you have many there, what my interpretation might be here. So what does the paper do? The paper presents this novel forward-looking approach to measuring climate risk, and the innovation sort of here, also relative to the other paper that Hyun has, is basically looking not just at transition risk, that they were looking mostly in the banking
in financial system paper that they have, but also looking basically at physical risk, which is definitely a concern if you look at BC insurance relative to life insurance. Yeah, so this is the focus of the paper, having both there and even combining them when it comes to capital shortfalls. And you do sort of both also here, estimating the physical and transitional climate beta for both types of insurers, where I think you argue well that basically the physical one is more for the P&C, whereas the transitional one with the larger financial asset holding would be for the life insurance. And then after validating and showing, I mean, you nicely showed it, the two different types of climate betas, you validate them, and then you go over to measure the capital shortfalls with the so-called C-risk measure during climate stress scenarios that are reasonable in my respect, and basically showing that for the P&C insurers, large exposures to risky areas correspond to high sensitivity to physical risk, whereas for the life insurance that have a high exposure to brown assets, they will have high sensitivity to transition risk. And the last part that I also liked a lot, I was a bit sad that there was not much interaction. I was like, okay, now she's combining it, something will come, and somehow either they're too protected or we're not estimating it well enough. She has even the compound risk where she is combining sort of the physical and transitional simultaneously plus the market risk and showing basically the capital shortfalls there. So in terms of contribution and my overall assessment of the paper, I think the contribution is very clear. There is not much literature on insurers, especially the exposure sort of to both physical and climate risks, and the topic remains very understudied. So I think I don't have to argue that the paper makes a considerable important contribution here. And introducing the market-based factor, I mean, the reason why it's understudied, because it's very hard first to get this interesting data that she has to validate it, but also to find a good measure, how to measure climate risk for insurers. And they try to overcome it by basically using the market-based climate risk factors for both physical and transition risk. And I think it's a very rich paper. I mean, we discussed it in the break. You might even split it into two papers because, I mean, I was thinking either it could be for the capital shortfall or you could do life insurance and BC insurance separately, since results look very different. And yeah, my discussion basically will be first on the empirical approach, then the two C-risk and compound risk measures and broad implications of the paper. To be on time. Yeah, so coming first to the empirical approach and the physical risk measures. So I have not done much on insurers. I did a bit actually work also with this data on from shelters for this climate events such as hurricanes, wildfire, and floods. And there's a very nice banking paper by Correa and Christoph Herper and Quarters that basically also looks at a similar topic for banks, where they also exploit this climate change-related natural disasters and showing how it affects basically how banks respond to firms that are prone to be exposed to the state. But I will tell you more about that later. So for now, what you're doing, you sort of, I think you're excluding earthquakes, but most of the events that you are sort of using now is basically all sort of natural disasters, not necessarily differentiating between climate change and non-climate change events, which I think is not a critique, it's just, I think it would be super interesting to see both, and you can easily do it, right? And sort of differentiating this for the real researchers for climate change that actually look what climate change means in terms of so the climate risk researcher, they actually differentiate, and this is based on this paper, between the climate change related factors, let me show you, which would be like hurricanes, floods, where there's wildfires, whereas, for example, winter weather would be not a climate change, or earthquakes not a climate change related risk. And let me show you here, this is basically the FEMA data. So the website is very cool, but you do not see the date. I was trying to figure out what is the time frame, but apparently they don't care. But what we see here is at least sort of for compound risk of natural disasters, so this would be all natural disasters listed in FEMA, and we see sort of the areas in US that have a very high exposure, and this is also similar, comparable to your measure, where you have sort of California and Florida is the most exposed, and Texas the most exposed states, right? But once we look sort of in different types of risks, so for example, hurricane risk, which would be a climate change related risk, we see sort of we have nothing in California, but sort of more in Florida. And when we look Now it's the old paper. Okay, I had a graph here on the also on the winter weather. So if you have here the winter weather, it would be actually everywhere around the state. I didn't want to use the earthquake because you don't have them, but the winter weather, except for Miami, I don't know, Camila lives in Miami, there's no winter weather in Miami, that was the only, but everywhere else you saw sort of winter weather spread out. So I think making this distinction and conceptually sort of thinking, is it just that they're protecting themselves generally against natural disaster, which has been always a business model, and how do they cope sort of with increases in this climate change related disaster, I think would be interesting to know. Yeah, so, and this is basically my first comment on the empirical approach, sort of separating between the climate change and other extreme events, and I think you can easily do it. And I mean, you also mentioned it already in your paper, right? Not all natural disasters are climate change, right? So you can easily do it. And I think also the table 1, where you sort of show across different types of insurers, their risky state exposure, it differs widely. So I think depending on how you define what is climate change related or not, the results might look different, and it's interesting to know. And related to that, and this again goes back to this banking paper that I like. So for now, what you're measuring by looking sort of at directly affected states is basically what you're after in the end, right, is the perception of climate risk by looking at stock returns, a response of stock returns, but it's much harder to sort of estimate it if you look at the directly affected insurance, because a lot of other factors might play a role. It could be like they react to the actual physical damage that happened in the past, it could be the future, so it's more of a mixed thing that you're measuring here. And I think one possible approach, I'm not sure whether you can do it, but at least, which this paper does, I mean, it's a completely different paper, but I think you can do that here, having the disaster-prone states, right? Finding similar insurance in disaster-prone states, and then you have like, let's say, something hit in Florida, right? So you have a flooding in Florida, but you know also it's very likely in Texas to happen something like this, so you want to look sort of at insurers in Texas, whether there will be also market response, which would correspond more to a perception of higher risk, because they know they, let's say, over the last 10 years have been also highly exposed to flooding, right? That would better measure sort of the future expectations of investors about this climate risk. And I think you could do this, and then you can sort of do not have to mix the direct effects, the indirect effects, and really trying to tease out this perception of climate risk. That is my second empirical approach comment. And basically, in terms of the C risk, which I also liked a lot, and I think you can write a lot also about the heterogeneity in terms of these types of insurers, right? So the plots are very interesting, and I was really surprised, I mean, you had such good measure, that the capital shortfall is so small relative to banks, but then you said, relative to the site is not, then I was like, okay, I believe her. So they just have smaller, for example, also for logistics, just smaller asset side. That's why financial holding, that's why it looks smaller. But generally what I find interesting, and I showed here several plots. So you have the main ones is sort of the physical risk for the PC insurers and transition risk for the life insurers. And it looks also similar with this compound risk. For the PC insurers and for the life insurers. And what I found interesting here is sort of that there's really the persistence that some insurers sort of never have to deal with it. I mean, they have always this capital shortfall they have to deal with others sort of, they always sort of in the positive side and somehow can deal with it. And I think it would be interesting to understand what is driving these differences and why does this wedge become larger over time, right? And going more into the heterogeneity, it could be the geographical diversification. You look also a bit on the size and the leverage. I didn't know which other factors, characteristics you can have, but understanding why, I mean, it's not like going up and down for all of them, why some are always sort of in the surplus where the others are not. And I think it would be just interesting, making maybe your paper too large. And I know I'm running out of time. So broad applications, I think it would be very interesting to see it also for Europe, right? And I mean, to see sort of more on the smaller insurance. And I mean, what your suggestion would be how to regulate that. Because I mean, you say that there could be this capital threshold they could use, which they don't have. Maybe you have a suggestion here. And then some minor comments in terms of, you can just look at them. So I think it's a very nice first comprehensive framework for assessing the insurance climate risk. I like the two metrics where you can see sort of both the capital shortfall, but also the combined risk. And here I would like to see sort of more careful differentiation between sort of direct versus indirect exposures to natural disasters generally or climate change related disasters, which I think you can easily address. It makes papers interesting. Good luck with the paper, and I really liked reading it. Thanks.
Thank you, Larissa. Right on time.
Yeah.
If you want to start answering her, and I put your names if you want to.
Sure. Thank you so much for your thoughtful comments. I like all of your comments. The first one, disentangling climate versus non-climate, we are, to address exactly that comment, we are developing hazard-specific factors. So we are going to have hurricane factor, wildfire factor, because wildfires are in California, but it's not in Florida. Exactly. So yeah, we are getting there. And the direct versus indirect effect, I'm also a big fan of Ricardo, Christoph, and I's paper. But we are limited by the data. We need a lot of regional insurance companies to do the exercise that you're proposing. But many large insurance companies are very well diversified, and there are only few that are really concentrating on specific regions. But we will try. I think that's a great idea. And the last part, the persistence in C risk is mostly coming from the size effect. That's why we want to focus on the marginal C risk and the betas, and we will make it more clear in the next version. But yeah, that's explained. That's why we want to focus on marginal C risk. I think we want to, yeah, we will,
you
we'll
had them
make
too.
that
Yeah,
clear.
when you present, that's what confused me. There were so many marginal risk, serious,
yes,
compound risk, marginal compound.
Yes, and we also have decomposition of the C risk. Is it coming from the equity, debt, or the beta? It's in the appendix. We have many results. We are trying to connect the dots, and your comments are going to be very helpful. So thank you for that.
I was interested in the stranded asset evaluations. So you mentioned that we had this spike and it was due to the change in prices, and possibly more awareness. But how about the carbon policies? So you don't have any exposures to any of the carbon policies which have been implemented. So I don't know if there's exposure to European carbon prices anywhere, but I mean, I would be interested to know a little bit more about that. And I think it should certainly be a subject of investigation, because we do want to know.
Yes, for sure. And that's a great point, because if we think about China, fossil fuel is not stranded. They are going to use it for a long time. So we wanted to develop regional specific transition factors. I think that's a great idea. We wanted to work on it, but hopefully we'll get there.
So I'm just curious about whether those insurance companies over time, they have some experience that their policy that exclude the kind of damages from natural disaster. So I don't know much about the US company, but sometimes it's conditioned that when the insurers look for compensating their natural disaster, really depending on the customer whether they buy this actual contract. Right? So,
yeah, from the insurance perspective, it's definitely harder to manage the risk. So that's why wildfire insurers are pulling out from California. And that's partly why we see that large insurance companies are having excess reserves, because the ones that are suffering are already exceeding. So it's your point is exactly right. Yeah.
But they are also subject to local regulation. So I was wondering what's the action for now?
No, we have that in the paper. I just didn't have time to present, but we find that the physical factor is primary for PNC insurers. definitely, it would be interesting to exploit the regional heterogeneity. California has cap and trade, but so yeah, we can, yeah.
More questions? I have a curiosity question. What's the coverage you get of, do you have the whole universe of insurers in the US or?
Only listed insurers because we need the equity prices to do this. And based on our validity exercises, it's promising in the sense that based on observing what insurance companies are holding, we can impute their market beta, which of course will require a lot of assumptions, but it's one way to think about how to measure non-listed insurers exposure. But in this paper, we are focusing on the listed insurance companies. Oh, it's majority. In terms of the share, it's majority. Yeah.
So let's thank. And let's move to the second paper of the session and the last paper of the conference. Can you
sit down.
Okay.
Nice report. Just like this and just
Thank you so much for still staying here for the last paper of the last day. And I know that me and Christina are standing between really long session and your lunch. And I hope that you can see the paper as appetizer so that you can enjoy your lunch better later on. So the paper that I present today is going to be about climate stress test, bank lending, and the transition to the carbon neutral economy. This is joint work with Larissa Fuchs from the University of Cologne. My name is Huyền Nguyễn. I'm at the Halle Institute for Economic Research and University of Jena. And Trang Nguyễn and Klaus Scheck, both at the University of Bristol. The paper is going to be about banks and what banking supervisor do to contribute to this green transition. And if you look at the articles recently about the role of banks in the green transition, you will see that there are a lot of different views on this. So either banks was facing grilling over carbon emission, or you see that there's discussion that they need to stick with the distressed polluter to help them in the green transition. And one reason that makes banks react in a very different way is because they don't have guidance. So there may be that there's some role for banking supervisor step in and provide some information that what banks should do when they face this increasing climate transition risk. So when we look at the literature, we see that even in the literature, it reflects exactly what we see in the new paper, that there are evidence some banks, especially the green banks, account for firm carbon risk in their credit supply and pricing. But there are also banks that they try to shift the risk away. So I have one paper that look at how banks selling the kind of polluting loans in the secondary market. And we also see that banks divest from those polluting assets by moving their lending to those polluting companies from their home country to the other country that not having, for example, carbon taxes. And we have the paper that show banks, they talk differently from the way they act. So they say that they
care about carbon transition risks, but at the same time, they just try to appear green and at the same time still trying to financing really polluting activities. Acharya et al. 2023 have this long survey about how central bank do the climate stress test, and they also call for more research on the effect of climate stress test. If you see on the figure, there are the blue line showing you number of banks, the central bank that engage in the green transition activities and taking into account environmental when they look at changes in regulation. So by 2019, we see the sharp increase and 50 central banks having some sort of policy, including climate stress tests that they build scenarios that hopefully can be implemented soon. So in our paper, we have two research questions. We look at the first climate stress test that central bank does in the world by the Central Bank of France. And this climate pilot exercise was in 2020. And we combine this information with carbon emission, borrower environmental performance from Refinitiv, and we look at syndicated loans in DUSCAN because we don't have the access to the ANA credit, which would be even better for our study. So the first question is that whether climate stress tests affect credit supply and the cost of credit to brown firms. And I will show you that we find the answer is yes. So without the climate stress test, we couldn't find any evidence that banks reduce credit or they ask for higher interest rate for brown firm. And after they participated in this climate stress test, we showed that participating banks, they are better informed about the long-term climate transition risks, and they actually increase the loan volume for brown firms. At the same time, because of the risks, they charge higher interest rate. And they do that in the way that they originate more loans with the green purpose so that hopefully these borrowers can better transform in the long run. So the idea is that if banks only look at carbon transition risk from short run point of view, they will see that maybe I divest and I lend to other type of borrowers. But looking at European firms, we see that banks, they have credit supply to 65% of their borrowers actually polluting customers. So if they do not try to provide green credit, but only cutting this credit, then no green transition should happen. So this is exactly the idea that they show, okay, now we need to still increase the loan volume for those brown firms. At the same time, we charge higher interest rate. And essentially, we make sure that these loans have some green purposes that supporting the green transition. The second part of the paper, we look at, so that is what bank supervisor do and what the participating banks respond to the climate stress test. What about the point of borrowers, whether after receiving these loans from the stress tested bank, do we see any improvement in terms of environmental performance and in policy that those borrowers try to essentially comply to the green transition? So this is the institutional background about how Bank of France and the French Prudential Supervision and Resolution Authority do the climate stress test. So they do it for both banks and insurers. However, for the insurers, they focus on the climate physical risk. And for the banks, they focus on the transition risk because of data complication, and also when they have some surveys, seems that these banks affected more in the long run for the climate transition risk. So the idea is very simple. They have different scenarios for how much carbon prices gonna go up in the next 30 years. So we have three scenarios. The baseline in the dark black line, you see that this is like a very gradual increase in the carbon price.
And then you have the delayed transition, that is no policies taken place until 2030. And then when we see that the climate change happen more quickly, and by then they need to do more regulation changes, and by that time the carbon prices going up even faster. And then finally we have accelerated transition with carbon prices going up to more than $900 per ton. So in this exercise, they have 9 banking groups and 15 insurance groups participated, and these 9 French banking groups represent 85% of the French bank's total assets. So that is really large exposure. The way they do that is that they look at both static and dynamic balance sheet. So in the short run, they let the participating banks apply the changes in carbon prices based on the portfolio, for example, loan to polluting companies, and estimate how much loss would that be for those banks if their balance sheet do not change until 2025. And after that, they allow the bank to have a dynamic balance sheet where they incorporated information that what would they change, so what kind of borrowers that they lend to, and then what kind of borrower that they would not lend to in the future. And then they also estimate the loss, the expected loss based on the scenarios and the new dynamic balance sheet. So this stress test is kind of different from the normal stress test in the sense that they don't identify any violators. So they don't have any capital surcharge. And in the official document, they say that this is voluntary. However, when we talk with the banking supervisor and the EBA, we realize that it's not exactly voluntary like in the official document, but they communicated with these participating banks and they asked them to participate in this climate exercise. So although they do not identify violators, they provide a kind of information channel. So they have the feedback from these participating banks, and they also provide information that what kind of information from the borrowers the participating bank need to collect from now. And they also essentially very transparent about the kind of scenario that these banks need to take into account going forward, that if this climate stress tests do not just happen in 2020, but also implemented in the future. So from data, we then collect all the EU denominated syndicated loans to French borrowers between 2015 to 2023 from DealScan. And these loans, they are for French borrowers, but can be provided by both French and foreign banks. So in this group, we will have some French banks that are participating in the climate stress test, and some French bank and foreign banks that did not participate in the stress test. We remove all the financial firms, and we care about the lending decision of the lead arranger, just following the standard literature. And then we merge the data with Bank CompuStat, Bank Focus for the lender characteristic. We also merge in CompuStat Global for borrower characteristic. And information on carbon emission and environmental performance of borrowers are from Refinitiv. So you can see that our results are going to be a little bit biased towards very large banks and very large firms in France. We also collect conference call data and transcript from S&P Capital IQ to test the kind of information collection exercise that these participating banks had after they learned from the climate stress test. So in summary, we have 1,673 loans given to 54 French banks by 116 to 54 French firms by 116 banks. On average, we have one syndicated loans that have the size of $600 million, maturity of 5 years, and loan spread of 202 basis points. 53% of the loans are given by stress-tested bank. And when we look at the firm level information, 39% of them getting loans from stress-tested banks. So the carbon emission is actually very diverse. It's ranging between -47% to 112%. So the first part of the paper where we look at how climate stress tests affect bank lending, we have a very simple identification strategy. We started with very simple regression on the loan volume and loan spread on carbon emission of firm in the previous quarter. And then we control for typical firms loan characteristic. We have bank fixed effect, loan type fixed effects, industry time fixed effect, and we cluster our error term at both bank and borrower level. Now for the effect of climate stress test, we run like kind of different framework where we have the interaction terms being the high emitter is the firm that having the average carbon emission before 2020, which is the time of climate stress test, above the median and zero otherwise. And we interacted with post T, which is value of 1 for the period from 2020 Q3 afterwards and zero otherwise, and multiply by the treated indicator, which are taking the value of 1 if the bank providing the loan L to firm F are the participating bank in the climate stress test. So we can imagine that we have a treatment group that are loans originated by French banking groups that participate in the climate pilot exercise, and the control group gonna be the loans that provided by French and foreign banks that did not or could not participate in the climate stress test because, for example, if they are Deutsche Bank, they're in Germany and they cannot really participate in the French climate stress test. So we run some just sanity tests to see how similar our treated and control banks are. And we see that in terms of share to high emitting borrowers, bank size, capital ratio, loan growth, and profitability, they are very similar before the climate stress test. We also look at loan characteristics, so what kind of loans that they give to borrower, so in terms of amount and spread, and we also see that they are very similar. And even the characteristic of the firms that receiving loans from two types of banks in our data, they are also very similar. They are similar in terms of firm size, leverage, and profitability. So the first result is that this regression we run for all the loans that banks given to firms as a function of carbon emission of firm before 2020 Q3, and we see that loan amount and spread, there's no significant relationship. This means that we couldn't find any evidence that without climate stress test, banks in France change their credit supply or pricing based on the carbon footprint of the borrowers. And next, we'll move to the result that how banks react to climate pilot exercise. Here, what we should look at is the coefficient on the triple interaction. And the first two columns, we have the result for loan volume. And the third and fourth columns, we have the result for loan spreads. The first and the third column here, we have no control variables, and the second and the fourth columns, we have all the typical loan characteristic and borrower characteristics. We, throughout all the regression, have banks fixed effects to control for all the kind of bank-specific but time-invariant characteristic. We have industry times year fixed effects, which is very important because for example, during the time that we have the climate stress test, we may imagine that there's also COVID was at the high time, right? And for COVID, there are sectors, for example, also high emitting borrowers operating the badly hit by the COVID time. So for example, transportation was really frozen, and the industry times year fixed effect also take into account the effect of COVID and make sure that our coefficient did not capture the effect of COVID there. So what we see here is that loan amount going up by substantial percentage, so it is almost 40% increase in the loan amount. But at the same time, the spread also increased as well, which is 8%. And 8% when we look back to the average spread in our data, which is around 200 basis points, this is also a substantial increase. So the next question is that if we see an increase in the loan amount and at the same time they charge higher interest rate for these polluting borrowers, whether that is for a green transition purpose. So we look at all the kind of loan purpose that contained in the syndicated loan contract, and then we find information whether that loan is containing the remarks such as for wind farm, solar energy, for the purpose of decarbonization, whether that loan is sustainability linked loan, and whether that is, for example, for the firms to achieve science-based target in terms of carbon emission. So here we see the probability of the loan being a green loan after the climate stress test is going up when that loan is given to polluting customers. And then we look at, essentially we aggregate the data and we look at the share of loans, so the green share that bank given to polluting borrowers, we all see that the share for green loans also increased by 4.6 percentage point. So it seems that there's some encouraging news that with the climate pilot exercise, the treated bank, they give bigger loans, but also for the purpose of green transition. Now we move to the mechanism. So why would participating banks actually change the way they lend and for the green purpose? And we look at all the earning calls that we could collect from the S&P Capital IQ. And those are some examples that you can see from Societe Generale. I hope I say the name not too wrong. And this is the time Q2 2020, which is right the quarter that the climate stress test start. And then we have also other time that see how these banks discuss about the climate stress test and the implication for their lending activities. So for example, the first snapshot, you will see that they say, okay, so it prepares us to handle all the upcoming stress tests that are going to be led by regulator and supervisor. And it's part of our disclosure also to collect information from clients. In Q2 2022, they have this discussion that they adopted different measures for measuring impact and asset vulnerability to risk, and they carry testing, stress testing exercise for the green economy. In the same quarter, BNP Paribas, they say that they have a new low carbon transition risk group at the bank that comprise of 250 professionals, and they stand to essentially increase the lending for the purpose of green transition here. So then we classify this information into 3 categories. The first category is whether the bank mentioned climate stress test after 2020 Q3. The second category is that whether they mention that they communicate with borrowers about transition risks. And the third category is about whether they have discussion about carbon emission. And in all 3 categories, we see that banks more engaged in this discussion about the green transition, and they also communicate more with borrower to collect information for the exercise. the final part of the paper, we then link it to, okay, so that is what the bank did. They seem to respond well to the climate stress test, but what about borrowers? Could we see any improvement in the environmental performance, or could we see any kind of decline in the carbon emission of those borrowers? So we then look at borrower level information, and then we run dependent variable being all sorts of environmental performance classified into short-term adjustment, which are easy to adjust, and the longer-term adjustment, which require much more effort, and it needs time for us to observe anything. So in the short-term adjustment, we look at Refinitiv and see whether the firm have information that they have new eco-friendly product. We also look at the ESG score of firms, and then we look at the part on environmental score, emission score, and then we see whether they have new emission policies or whether they develop some concrete target how much carbon emission that they need to reduce. For the long-term adjustment, then we look at whether firms engage in using more renewable energies, and we look at also whether the total emission growth and direct emission growth in their production decline. We also look at whether they have some changes in supply chain policies. So, for example, whether they terminate contract with suppliers that are environmentally unfriendly, or whether they source materials that based on some environmental criteria. So the treated then are the firms that receiving credit from stress tested bank and are high carbon emitter, whereas the control one are the one that did not receive any credit from stress tested banks. So we see that for short-term performance, we see quite a positive picture. They are more likely to have eco-friendly product, the ESG score, environmental score, emission score, emission policies, and the target for emission all going up. But when we look at things that are harder to adjust, we see that why we observe a weak evidence that the use of renewable energy over total energy source going up, but we could not observe yet any decline in the total emission growth or direct emission growth. They also do not change anything about supply chain policy and do not terminate contract with environmentally unfriendly suppliers. So other findings that I do not show here is that banks that are considered green, so they are signatories of the UN Principle for Responsible Banking, or the banks that have institutional investor, they are the ones that show stronger effect. And I'm gonna just conclude here. So we believe that we are the first to examine the type how banks respond to climate stress test. And essentially what we see is that banking supervision can have an effect on the green transition. They have especially a strong effect on the lending side. However, what we see is that the transmission from what the borrower do after they receive the lending are still limited. So we do not have any strong view here yet, whether it is about greenwashing from borrowers or it is just that we need more time to observe these evidence. So we hope that over time when we update more new data, we also see some more positive picture on the long-term effect of borrower as well. And now I really look forward to the discussion by Christina.
You have preempted a few questions, but anyway. I'm gonna stand because I also prefer standing if it's okay. Yeah. So the first thing I want to say is that I am very happy to be here today, and I really appreciate the invite. I met a lot of new colleagues and also new friends, and that's really what is the spirit, I think, and it's a very nice event, I must say. Last year I couldn't make it, I got COVID and I couldn't come, so this year I had to make it, and when a woman wants to make it, it makes it, and that's, I want to show you where I got the invite for this conference. I was actually on that little island in Greece, and yeah, it's actually Leros, it's a church in the middle of the sea, and actually Caterina managed to send me a message there, because when a woman wants something done, she makes it done. And actually, yeah, so that's me. I got the text while walking up the stairs. So it was actually, I thought it was fitting to show it. And as I said, Caterina gave, well, you all gave me the opportunity to read a new paper that is particularly relevant from policymakers, because the discussion is, should we do more? How should we get the transition done? Can we help somehow? And we like to pat ourselves on our shoulders, thinking that we do most of the job. And therefore, this paper, in a way, it gives us some good insight on how many things we need to think about. So let me just put the paper, just give you a few lines about the paper. The paper basically tried to study whether climate stress tests affect borrowers' environmental choices via their impact on banks' lending decisions. And this impact should be via the information production, right? And there are three main findings. First, the participating banks lend more to high carbon emitters firms, but at a higher cost, so they get compensated for it. Then, basically, the participating banks produce more information about the environmental situation of the firms they lend to, so their emissions and so forth, and they boost something that you call the green lending. So basically, they help them invest more in green investments, so greener. And borrowers actually of the participating banks seem also to get a push, and they start investing in a more greener way. So solar plants, windmills, all, you name it. And the effect is a short-term effect, but we have a problem with the time series. A long-term investment is very difficult to measure. So, and that's why I think you mostly have short-term results. All right, the identification strategy. I'm an empiricist, so when I see an event, I jump, because I think, wow, that's it. We have solved all problems. And they have a very cool event, which is the pilot climate stress test that the French authority did using 9 big French banks, which I think are also involved in the normal stress test. So the climate stress test was run between 2020 and 2029, and they combined this event with, of course, loan level data, which, as Julian said, they don't have ANA credit, so they had to use syndicated data, which has been also used by other papers in the same context. So, and they actually look at French and non-French banks that lend to French borrowers. Some of the French banks have been involved in these stress tests, some of the French banks have not, and so have not also the non-French banks. So they have 9 banks. This is also a very concentrated market. These 9 banks that actually participate to this stress test were actually forced to participate. It was not voluntarily. If you read through the material, they had to do it. And they cover 85% of the market, of the lending market, right? And then, of course, all of the emission data and so on comes from Refinitiv data set, which is one of the most common data sets. All right, so contribution is clear, so I will not get through contribution because I don't think lunch will be waiting too long for you. So this discussion will be about one single question. Can the results be interpreted as solely driven by the information production prompted by the climate stress test? I call this the elephant in the room, because the identification strategy is all around the quality of the event. And that's where I'm going to dwell most of my time. All right, so first and foremost, as I said, great event, right? The problem is that's at a very bad time for identification purposes. Why? First and foremost, the Paris Agreement was signed a few years ago, and that pushed a lot of regulatory pressure and market pressure for sustainability increased a lot. So sustainability became top of the agenda for the regulators and the firms and the institutions. Everyone was more interested in sustainability more than before. The other thing is that the climate stress test, many began in 2018, and I must say, and again, significant momentum in 2021. So a survey by the Financial Stability Board in 2022 found that worldwide, 67 climate stress tests have been completed, were ongoing on planning by 2022. And actually, I did a ChatGPT search to figure out when this was going on. And ChatGPT was telling me that the first one was actually the Dutch central bank who started working on this in 2018. And then in 2021, there were many other authorities. And then, of course, up to 2022, even the Federal Reserve started talking about it, right? Double check, I should double check because this is ChatGPT, just stressing it again. But even the Financial Stability Board suggests that basically, and in fact, they have a list as well. But anyway, so the first thing is, banks from US, Europe, and Japan dominate the syndicated market, right? So the majority of the firms of the banks that you have in your sample have somehow been affected, most likely, by this kind of stress test over the period 2018-2021. So my main comment is, we don't know enough about the non-participating bank, right? We don't know where were they located, the non-French banks, where are they headquartered? And also about the non-French banks, how much are they relevant in this kind of market? Now, we don't know, for example, about the overall lending portfolios of these banks, because the syndicated market is a part of the lending portfolio, but they do much more lending activity, and also the lending specialization. And I was reading about the GSIPs, and in the GSIPs, for example, they are very much prone to invest in very high emission firms, and 4 of the banks that were in this stress test are actually GSIPs. So there is actually a selection toward investing in very high carbon intensive firms. And then basically, I think there's some more tests. I saw you that you were showing the t-test about the characteristics of the banks. I didn't quite understand why you show changes and not actually the variables. And also I was thinking that in that table, you should show more about green share or specialization, more information that tells us about the culture at this bank when it comes to investing in the green economy. And then I have a bonus question, because I actually work for the central bank in Sweden. We don't have macroprudential policy or supervision, but I talk a lot to the banks anyway. And it's very clear also in our press that banks behave very differently, and you were mentioning also some academic papers. Even the Swedish banks, they lend green in Sweden and brown abroad. So there is also this thing about the non-French banks. Maybe they were subjected to climate stress testing of their own, but they actually behave differently. I don't know. It was just a bonus question. So the other thing is that several of the 9 banks into the stress test were leaders, and they love talking about it, of sustainability and adopting sustainability activity since 2015. And actually already in 2015, 4 of the largest banks involved in the stress test pledged to exit brown investment. And then your results is that basically they have lend more to high emitting firms, even though they actually charge more for it. But then it might be so that these banks did not intend to disinvest, but rather invest in brown industries that actually were more likely to engage in the green transition to begin with, or maybe your measure of high emissions does not really capture the very high emitting firms in their portfolios, right? Because I think you do the median in sample, right? The high emitting dummy is calculated in sample within the 54 firms that you have. So you might be missing some of the distribution, I don't know, but that's, yeah, we can talk later. Then there is this problem with sustainability initiatives, because it's true. I mean, all of the banks in the stress test joined the initiative, the net zero banking initiative in 2021. So the timing, as I said, the event is great. The timing is a bit complicated. And they actually, and I've also talked to many of the Swedish banks, and they were doing some preparation work to get into this stewardship. They do stewardship. So they actually, what they do is they help their firms understand better how to transit or things like that. That's one of the activities that actually is involved into this network. So some additional comments. I think the paper is very nicely written. It's just that to get to the data part, I had to get to page 15, which I think should be kind of, come first. You do a great job explaining the exercise and everything has happened, but I think you could make the first part a bit shorter. In general, I find that, some things can be improved, but also maybe you should control for demand by the firms, because, we know that by 2021, firm investment in sustainability reached 35 trillion of US dollar globally. So there was also more demand for actually this type of loans that would be devoted to the green transition. So Yeah, and also I thought that you had 151 firms, but you said that you have 54 firms because I was a bit confused. So I also think you might want to look through the tables and make sure that things are more consistent. And that's it. I mean, from the policy perspective, this is an important paper and it's very timely. We talk about this every day, also because we want to have capital charges attached to this. So that it's like, that's why it's an important one. What is important though, and I want to stress this, that even if the banks themselves have started the process of greening their operation, if we can make it faster, if we can help them get there faster, if we can give them the extra push, that will be still important. I don't want that island that I show you to begin with to be flooded and not never be able to walk on it again, for example. So it's actually very selfish why I do this kind of work. And that's it. The paper is very interesting, and thank you again for the opportunity.
Thank you. Maybe you want to take some time to answer Christina, and we start gathering.
So thanks a lot for the great discussion. I really enjoy it. And I also agree with a lot of points that you raised. Just some short answer about the characteristic of the non-participating banks. So you already showed that the nine banking group in our sample, they also engage a lot in the other green networks. Now, when we look at the non-participating banks, they are also the banks that very much engaged in these other non-green networks as well. So in terms of whether we have these differences there, we don't. And your point, the second point about a lot of other central banks started doing the climate stress test. So the difference between the French climate stress test and the other climate stress test, at least in the 2020, was that the other central banks, they don't do the bottom up where they allow banks to really calculate the loss based on their models and their portfolios. Whereas the other central banks, especially the ECB, when they started this first exercise in 2022, the 2023 is also a bottom up, but the 2022, 22, like right before the bottom up one, they estimate based on the information that the bank submitted to them, like based on the balance sheet. So there's no dynamic calculation there. So that's why we use the French climate stress test instead of the other one. And I have a short answer a little bit to the point of, okay, so whether it is really just French climate stress test or the other climate stress test, it doesn't answer all the questions, but exactly. So we have a test that exclude the time from 2022 onward when the ECB started doing the climate stress test, and our results actually showed quite similar to what we observed, or a little bit actually stronger effect on the loan spread effect. So on the other part, I think that we can discuss over lunch, and thank you so much. It's really great discussion.
Do we have any more questions from the floor?
Performs a climate stress test. Who goes and check that it's true that you?
So for the exercise itself, the French banking supervision, they only provided the carbon prices changes, and the banks themselves have to calculate what would be the loss based on the loan investment portfolio that they have at that point. So
the estimates of how much carbon they're using or not using comes from there.
So that is that, yeah, so in the first exercise, they use any information that available. When something not available, they look at the industry level carbon emission and calculate that. That is unfortunate. But then because of that, when we show in the earning calls, that's why they started to collect information and ask borrower to also share this information with them so that they can better estimate for the future. So, but for the first time, yes, a lot of firms actually, they base on just the level of carbon emission of the industry and then estimate.
Glenn.
Thank you. I wonder if the effect of climate stress test has not been to generate more information so more questions from the bank to the companies. And I don't know if you can capture that in the analyst calls, but asking precisely these dynamic effects about, you know, are brown now, but indeed, what is the plan to cut carbon emissions? Because the banks have to report to the supervisor. The supervisor is interested in these dynamic, you know, types of responses. Evidently, there's a lot of exposure to Total. You might want to know what Total is going to do. So this information provision, I wonder if you could capture that in your, because I think it's a key element of the transition.
Yeah, so we have started collecting information from the earning calls, but in our to-do list, we also now collect information on the sustainability reports as well. So some banks, they have these separate sustainability report, and what we do there is that we then capture in those sustainability report whether they ask borrowers to provide more information, whether they establish a kind of task force that focus on the green lending and green investment, and also we capture like some information that is kind of quite funny to look at, like how many pages in the sustainability report are there, because when we cannot read the whole 100 something pages, maybe the banks that discuss spend more time and spend more pages to discuss, at least there's some kind of information in there that may be interesting, but it's not a perfect measure. Thank you.
If I may add something, I mean, you answered correctly. There were not many bottom-up climate stress, but by now there are many more. So maybe answering Christina's point that you have short sample, you could use the cross-section. Also, there's many regulatory developments that oblige not only banks, but also firms to report much more. So I'm sure it's not very easy, but as a robustness check for your particular event, you could draw more information now that is available for many countries.
Yeah, that would be great to have some kind of external validity for our test.
So anyway, let me thank both of them for the paper and discussion. And maybe Elaine, you want to say something?
I'm pushing you away here. Okay, before we all disappear, I really, really want to thank very wholeheartedly the Bank of Spain for this amazing, really organization, and I think we all enjoyed it very much. I really learned a lot. I think we also laughed a lot, which is a very good measure of success. So in particular, greatest thanks to Beatrice and to Eva here for having done such a great job. Also, thank you very much for Katerina, who couldn't join, unfortunately, and so we missed her, but I don't know if she has watched us. I hope so. Thank you also to Fiorella. Thank you to the CEPR staff, to Petra and Spoena, who have done also a fantastic job. Also, I want to thank the people who reviewed all the submissions of the committee and graded them very dutifully. So thank you to all of them. And finally, thank you to all of you who have been presenting and discussing. It was really great. So see you at another place, another time, but it was fantastic. Thanks a lot.
So just one little thing, thank you very much. It was a great honor to host this conference. And I wanted just to thank you also, Luisa, Javi, and, and Teresa, who've been like helping us so much from Banco de España. So thank you very much.
So in case you're still hungry, there's after all these 2 days.